All right, well, everyone. All right, welcome to day 2. And to start with our
Thank you. Thank you so much for having me. I'm really excited to present this paper, which is joint work with Victoria, who just graduated from Harvard. And it's called The Making of a National Mortgage Market and Its Effects on American Cities. So I guess the motivation for this work is really that mortgages are quite important in the financial lives of US households. And owing to this idea that, they help homeownership, and homeownership has always been a politically salient objective for US policy, the government has kind of intervened a lot in these mortgage markets and made what is today an exceptionally different product, especially in an international comparison, in terms of the 30-year fixed rate, fully amortizable, relatively affordable mortgage. And there's a lot of great work trying to understand what are the impacts of these mortgages on homeownership, prices, especially from a more cyclical perspective. But a lot of this work exploits individual level evidence that looks at my mortgage compared to someone else's mortgage. There is a little bit less on what is from a macro standpoint, what is the effect for an entire economy of having mortgages which are 1 percentage point rate lower for good. And that's kind of the question that we try to ask in this paper. And the way we do it is we go and look at a period in which the mortgage changed and became the mortgage that we know today, which is the wake of the Great Depression, when the federal housing policies were enacted and created what was the affordable mortgage that we know today. I'm going to show you that this is a good setting to ask this question, because we can get the sort of micro level identification that we like and allows us to look at cross sections, but we can get it at the city level, because this is going to be a uniquely large, spatially heterogeneous, and persistent shock to mortgage conditions. And so the paper really starts by documenting that it is a good setting to look at what are the effects of more affordable mortgages at a more aggregate level. And the way we do it is we document that before the 1934, there were very large differences in mortgage rates across cities. So if you think about cities in the West and in the South of the US, like Dallas, they had very high mortgage rates, 7.5, 8%, whereas cities in the rich and old Northeast had mortgage rate around 5.2, 5.4. Yet in 6 years, just after the federal policies, these mortgage differentials converge quite rapidly and go from 300 basis points to just above 80 basis points. And so this is kind of the fact that we go off with in the paper, and the paper has 2 parts. The first part asks, well, what caused this convergence? What caused rates to converge to effectively the same level despite these very large initial differences? And we're going to show that there is really a unique role for the federal housing policies in creating this convergence. This is a convergence that is driven by the policy. This is going to be the first part of the paper, and the reason why this is important for the paper is that we want to have a handle on why rates change in these cities. And this part gives us a sense that this is a supply shock that comes from the federal government, allowing this mortgage capital to flow from the Northeast to the South and West and equalizing rates. Now that we have a good supply side handle on why mortgage rates change at the city level, well, we can look at how these cities evolve in terms of macro outcomes, such as homeownership, prices, construction, and household formation. And what we find is a city that receives a 100 basis point lower mortgage rates because of these policies, sees large increases in homeownership, but very little effects on prices, and an increase in household formation in terms of higher fertility of young women that were exposed to this shock. So let me just place it in terms of the literature. which is, well, we obviously stand on the shoulders of a very large historical literature. I think there's kind of three strands of this historical literature. One strand is the one that has looked at US mortgage market and policies just in an historical perspective, describing the many revolutions and evolutions of this in this market. The other one is the literature that in more general has looked at regional differences in lending rates, how they converged over time. And then because we look at the wake of the Great Depression, we also relate to the literature that has looked at household borrowing and the Great Depression. What we do here is we have a panel of 266 cities, so we can study differences in interest rates, not at the regional level, but really at a very granular city level over time. And we can use these cities to really show evidence of how the mortgage as we know it today really evolved, started in those years, and also created an effectively national market. This allows us to relate on what are the effects on homeownership. And as I was telling you, there are many interesting, especially micro-level studies. Dan Fetter's work is quite relevant for us, for instance, in which what they use, for instance, regression discontinuity around the eligibility of veterans to mortgages to see what are the effects of cheaper mortgages on homeownership. Well, we have a different identification strategy that uses a macro shock and compares one city to another that receive different mortgage conditions. And I think the advantage of this that complements this existing work is that we can also look at prices, because also prices and all the sort of equilibrium outcomes that happen in the market are adjusting because our identification comes from a city, comparing one city and another. And very surprisingly, we extend Dan's results by showing, well, even at a setting in which prices can adjust, actually homeownership still stayed up. And this is really striking if you take it in contrast with today's studies. If you take today's estimate of how cheap mortgage credit would pass through to consumers, you would ask the average economist that has worked on this recently, they would tell you, well, it's gonna increase prices. It's not really gonna increase homeownership that much because supply of housing is not very elastic. What we find at the time is that supply of housing was extremely elastic compared to modern standards, and affordable credit resulted in affordable homeownership. The last literature to which we relate is the one on housing cost and fertility, building on the fact that this affordable cheap credit effectively translated into affordable homeownership. What we find is this affordable homeownership enabled families to kind of start their family earlier. A woman that was exposed to a 1 percentage point decrease in mortgage rates during her lifetime, she starts having children 0.74 years earlier, and over her life she has 0.13 more children. This highlights the link between homeownership and fertility, which has been the focus of much debate recently. So let me go to the data. Yeah. Yes. Yes. Yes, absolutely. So that's a great point. And that's why I'm going to show you when we go to the elasticities, we do it at different horizons, especially because if we look at 1934-40, which is the start of our shock, you might be worried that maybe there's a lot of vacant homes. So that's why we find a lot of adjustment of quantities and not on prices, because there was a lot of vacant stock. We digitized new data on new permits exactly to try to shed light on this. Was it just that they were moving in on new homes? And we find just new construction overall. So we just find new supply of new homes. And then if we indeed extend the window to 1950, we're gonna see that this kind of high elasticity is still persistent in 1950. But so I have more on that, but that's a great question. So the data that we have for for 266 cities from mainly two sources. One is the 1920 Census Special Report on non-farm mortgages. It's kind of a table of that report. And the other one is the 1940 Census of Housing. So basically what this gives us is kind of mortgage rates, mortgage quantities and mortgage interest payments, and the amount of mortgage homes at the city level for this panel of 266 cities. We have also two extra snapshots. One is 1934 and one is 1950, in which we have a smaller amount of cities, but roughly the same type of data. So I heard from Jonathan that you found them in some box, that there's some extra. Yes. So we're looking forward to expand the tax price. So this gives us a city level panel of home values, outstanding debt, and interest rates. What we do not have, and I want to be clear because we cannot do much about this, is we do not have data on initial loan to value ratio, share of amortized loan, and FHA insurance. So we cannot construct at the city level those kind of variables that would allow us to also shed light on other things that were changing during this year, which is that the mortgage was becoming much more long maturity and much becoming amortized. We don't have geographical variation that we can talk about the time series, but we don't have geographic variation. Correct, exactly. But we don't have it from 20, so our main sample of cities. The extra data that we have is because I'm going to kind of hammer this point that this is a persistent shock, which is kind of useful to think about elasticities. You know, we want to think about people's expectation, like how much this is going to last, is that we added some physical copies taken from the National Archives of saving and loan reports from 1960 to 1966 to kind of keep looking at mortgage rates over a long horizon. And we're going to see that, you know, this has been really persistent constant shock. We complement this data because we don't have data on these terms, and we don't have initial LTVs and stuff like that. And we did want to kind of shed some light on it. We complement this data with NBER loan cards, another great resource found in a box, which was this was Claudia's doing. It's a survey that the NBER sent out to lenders in the 40s, asking these lenders, give me the sense of the initial conditions of any mortgage you've done in the last 25 years. And so these lenders would go back in their archives and tell the NBER, look, in 1920, I've made a mortgage in Kentucky, in this town, and the initial rate was this, the interest rate was this, the amount was this, the appraised value was this, and the amortization schedule was this. Now, this is great data for to add to the time granularity of our study, because now we have it for every year, but we don't have it at the city level. So any evidence I'm going to show you with these loan cards are going to be at the region level, because it's 22,000 loan cards for 28 years. So just the sample is too small to go at anything that is below big region, because we don't have enough data for the cities. Good. So that's our first result, and we're basically going off of this for the rest of the paper. So what I'm plotting here is each dot is a city that with a given mortgage is the mortgage rate in a given city. The cities are colored by their census region. And what you can find here is that in 1920, well, there is quite a lot of dispersion. Rates, as I've anticipated, go from 5 to 8%. You look at 1934, kind of the same. And then by 1940, though, it's dramatically different. The compression in mortgage rate is, they go from 300 basis points to 100 basis points. But what this means is that these guys that were here, the mortgage is became relatively much cheaper in 1940 relative to the same guys that were here.
So are these all private mortgages?
These are all, yes. No, including, it's not including HLC, exactly.
But is that, I mean, if all this was convergence,
yep,
you would expect that the low interest rate places would see rates go up. I mean, so you're also seeing either a reduction in demand or more likely an increase in the supply of loanable funds. Right?
Oh.
So how much of this is about drawing more funds in as opposed to the integration of these separate regions?
Yeah, so ceteris paribus, I completely agree that, of course, you would see kind of like, you know, if I had a complete in a vacuum and just would converge it, I would see this going like roughly here. But the long-term rates are changing over this period. And so actually the long-term rates of US 20-year bonds are going down, and I think the mortgage rates are just following the long-term rates. So we don't have identification on what is the aggregate mortgage rate, counterfactual aggregate mortgage rate, but so we're going to think about, yeah.
We're at all difference in macroeconomic conditions. 1920, or in the midst of a high and variable inflation, especially hits the South and the West. So it's a much more risky area to the commodity boom and crash. So
yes. We have a lot on that. It's going to be like the idea of the first part of the paper is really try to understand whether this is coming from, risk has changed in the South massively over these 6 years, and it's not anything about the supply of credit coming in, or whether it's really something that it's like, I'm going to show you, it's something that it's hard to pin on. It's hard to say that the federal policies weren't having an effect. But we're going to think about all these confounders. These confounders have two issues for us. One is, well, we want to know what was this shock, the origin of this shock. So we just in a positive way, we want to describe the right shock. But then second, these confounders, you might worry that they're also affecting the macroeconomic variables that go after. And so that's going to be the second part of the paper. For both things, we're going to spend quite a lot of time.
Like you can see if something similar was happening with farm mortgages, or what you can say with farm mortgages.
So farm mortgages, so it's interesting. If you look at the American financial markets, they've integrated in succession. So farm mortgages were already quite integrated by the 1910s because there was a policy very similar to this, but acting on farm credit. Commercial paper markets were integrated even before, so, and then commercial lending markets integrated with the. There is papers that have studied that at a more aggregate level, and so we know that the farm mortgages were kind of commercial.
So they pass these things where they have federal land banks and things like this, and so that drops mortgage rates there. And then in the 30s, they actually have 3% mortgages on some 40-year loans, things like that that come down to federal code. So I have a question: is the box the standard deviation?
The box, I think, is the 25 to 75th percentile. Yep.
Because Howard Bonehorn has its interest rate.
Yeah, we're going to use that.
Okay. So next, they were like the standard deviation was like 1%.
Yeah. Yeah.
It was fine.
Yeah.
Is that pretty similar to what you're?
I'm going to have a picture for you.
Yeah, you said this, but is 50 just conventional, or is it?
50 is all. Is all the average mortgage rate. Yeah, and then from 60 onwards, we have SNLs that is mostly conventional because they weren't using much FHA.
One bunch of data.
I want all the data you have, Price. And just to be clear, you already shared so much to be clear with the room. Like we already have.
They have these surveys in the HLC survey. Almost every lender in all these cities that they study.
Oh, nice.
And so they usually have 3 years worth of data.
Ah.
A lot of it's kind of similar to what you've got. Problem is it's stuck in this damn Excel file that's really messy.
Okay. No, but we're happy to know. Yeah. No, anything, especially in that period, it's very useful because all of our thing is going to be that period is really important. So this is another way of looking at this convergence. Is like, okay, put cities on the x-axis by their mortgage rate in 1920. And on the y-axis, put the mortgage rate change between 1920 and 1940. It's kind of like, the Barrow convergence regression of GDP per capita growth on initial GDP, but we do the financial equivalent of changes in interest rates on initial interest rates. And what you find is quite striking convergence path for which places like Dallas that had initially 8% interest rate, the interest rate goes down by 2 percentage points. In Boston, it doesn't budge almost. And so basically what happens is like this spread is going down quite rapidly. And I mean, just the kind of the magnitude is a city that at a 1 percentage point higher rate sees its spread erode by 77%. So our point, our first part of the paper is going to say, well, this is because because of the housing policies that were enacted, and the way we think about it is that that borrows on the work by Ken, by Price, by Jonathan, that describes the markets at the time, is that by 1920 mortgage markets are really clearing locally. They are dominated, 70% of lending is dominated by either saving and loan associations. They're called building and loans, they changed names. We'll call them building and loans throughout just to be consistent. These building and loans had very little access to national markets. And the other lenders were individuals, like either the people that were selling you the house would give you a second mortgage on the house, or they were the builders. So 75% of the market was with these lenders that had no access to national markets. So what this means is that in a city in which mortgage demand is much higher than the supply of savings, well, the price has to go up. And that's kind of one of the reasons why we see these differentials is that in Boston, there's much more money relative to the demand of mortgages rather than that compared to Dallas. There were some national lenders like life insurance corporations, but they made less than 8% of the market, and probably they faced high costs in managing this long distance portfolio. All these lenders were basically in the Northeast. What happens in 32, 38? There's two main things. There's a lot of things that have happened, but two main things for us, which is one is the creation of the Federal Home Loan Bank Board system. So this system is like the Fed, but for the Saving and Loan Association. It's like the discount window of the Fed, but for the Saving and Loan Association. It's basically a saving and loan that didn't have that didn't have funding to lend could go at the Federal Home Loan Bank Board and ask for an advance on their mortgage that would fund it. The Federal Home Loan Bank Board was giving this advance at the same rate, up to differences of like 0.5 percentage points, everywhere. So basically, if you were saving a loan in Dallas now, before you were starved for funds, and so you had to kind of increase the prices, now you could go to the FHLB and say, well, can you give me an advance on this mortgage? And and so this equates the marginal cost for lenders everywhere.
Be careful now. So depends on what year you're using, because Jonathan and Ken, you tell me over and over again, okay, but he personally did nothing 32 or 33.
Yeah.
So you want to make sure you look at the timing when
Yeah, and they actually, yep. Yeah. So we're gonna look, we in the macro part, we're gonna take this as a shock between 34 and 40 overall, which is a package of all these policies. I have one picture for you that is going, well, it's in the appendix, but yeah.
As bankers choose between taking a farm mortgage and
Yes.
As we're saying, the farm mortgage rates converged earlier. So then it seems like a state like Dallas, where the rates are still really high for home mortgages, did bankers decide to start supplying more home mortgages to get those high rates?
So this owes to a little bit of degree of segmentation within market. There's different lenders that are specialized for different types of lending. So commercial banks, for instance, they had some access to national markets, but much less than what we think today. And they weren't as present on mortgage markets. A lot of this segmentation comes even for explicit regulation, like commercial banks were prohibited to do mortgage lending unless they matched it with very costly time deposits. And so a lot of this comes from segmentation within market, for which effectively equalizing rates in one market does not spill over completely to other markets. But of course, I mean, I'm pretty sure that, you know, giving this farm has freed up some other credit for mortgage. It's just not, you know, one-to-one in a sense.
So it's still over into for small businesses.
And actually, I'm going to use that as a placebo to show, not really a placebo because of this kind of market interaction, but I'm going to use that as evidence to show you there was something really special to mortgages. I'm going to look at commercial lending rates in comparison to that. The other thing that happened is that the FHA and Fannie introduced government insurance on the secondary market, which basically is integration on the asset side. Now you don't have enough money to have a mortgage, well, you just can do the mortgage and sell it off. And so that's effectively another way in which money can flow to this region. Plus, I mean, the insurance might have played a role. So what are the characteristics of this convergence that should follow with this setting that I'm sketching out? One is that, well, the timing of the convergence should be, I'm making this huge deal about the federal policies. Well, I should see the convergence happening in 3440 rather than before. The other, and I think this is related to the question that came before, this is a supply shock. We should see that prices in Dallas are going down, but quantities are going up. And this is related to what we were discussing before, because we're talking, it's not that Dallas's mortgage rates went down because of weak demand, it's because money came in. And then, and this is related to the conversation with Leah, we should see that this is much stronger in those markets rather than other markets, because there is some if there is some segmentation within the market. So this is kind of a low power test in a sense. So let's start with the timing. So I'm going to do the same exercise that I did before, but then I'm going to split them now from changes in 1920 to 34 and changes between 34 and 40. So again, same cities on the x-axis. We have just 42 cities pending prices, new 18. Fantastic. And what we find here is that the convergence between 1920 and 34, well, was happening a bit. The convergence is 0.22, and if you take it annualized, this is close to 2%. So every year 2% of spreads are eroding. This kind of the iron law of convergence happens to hold also in our setting. But then between 1934 and 40, this is really dramatic. The convergence rate shoots up 9 times, the convergence rate of 18%, and spreads erode by 0.56. So really, this picture shows you that most of the action is happening in 34. If we use the NBER loan cards, in which we have yearly data, we can paint the same picture and show that, again, most of the convergence is really happening between 34 and 40. Again, you can see also that the rate is going down, but again, this is really what's happening to all long-term rates. So it's part of several things that were happening in aggregate in the US economy. What our main point is that these spreads are narrowing exactly in those 6 years when the federal policies are happening. The supply shock point is we can do it with quantities. So we can repeat the same regression. Again, see this by initial mortgage rate on the x-axis and changes in quantities now. So this is if we just do debt. We can see that debt is going up in places where prices are going down. So mortgage debt is growing in Dallas, which is sort of the place in which the prices is falling. And we can do this either with total mortgage debt or relative to home values. So if you were worried that it's home values that are moving mechanically. And so it's both that the leverage of the city is going up and also that just the quantities are going up. And this is what we were discussing and how our data comes in which what we can do, and this is really the thing that kind of convinces us the most that we were onto something, hopefully, is we compare mortgages with other forms of lending and look at the dispersion in interest rates between commercial lending rates and mortgage rates. So if we just take a scatter plot of the 1920 rates, well, we see that those places that had high commercial lending rates also had high mortgage rates. This is kind of really in line with the conversation I was having just now with Leah, in which is like, well, you know, these places are really starved for capital, and this being starved for capital shows itself in many financial markets. If we look at the standard deviation across space and the distribution across space of mortgages and commercial lending rates, we see that they're roughly similar. Mortgages are less dispersed, which kind of makes sense because it's only one type of lending. Commercial lending rates capture many types of lending. And by 1920 and 34 kind of behave similarly. They are converging a little bit. But by 1940, the convergence in mortgage is nowhere close what you see in commercial lending rates. It's really quite special to mortgage markets, the degree at which lending rates have been converged. And the data sources are completely consistent over time. There's nothing that we're not changing data source or anything like that. It's really something really special about mortgage markets. In the paper, we don't have time to look at it. We shed light on whether this might have been really just supply of capital, or maybe the FHA was insuring mortgages in a way that was not really spatially conscious, meaning that they were insuring mortgages at the same rate in Dallas and Boston, and somehow Dallas was riskier. What we find is that it's very hard to actually think that only insurance was happening. There is we have some more direct evidence of convergence coming from these inflows of capital rather than spatial insurance. In particular, we find that most of the convergence comes from building and loans. These guys at the time were not using FHA at all, less than 10%. So this is not, insurance is really something about now there is a national market. So let me go to the second part, which is, well, now we kind of have a good handle on the fact that have a supply shock to credit in cities that we know its source, because we've kind of tried to convince ourselves that really it is a shock to mortgage rates that comes from these federal policies. Well, let's see how these cities react to that differentially. And the way we're going to do it is we're going to look at two cities based on their initial mortgage rate and look at their evolution in all decades after 1930 by running this dynamic regression in which we have the coefficient for the initial mortgage rates, the beta TM, that captures the differential path of a city that had a 1 percentage point higher rate in which rates decreased relative to the average city. And then obviously we wanna be careful about controls. One control that we think is particularly useful for us is the coefficient on bank loan rates in the 1920s. In particular, we're controlling for the initial commercial lending rate as a way to assuage concerns that, we might be just capturing catch-up that is related to initial capital scarcity. The idea is this kind of initial commercial lending rate kind of captures this sort of capital scarcity that could be correlated with future growth. We always use region by year fixed effect. So I've been running on this Boston versus Dallas example, but that's actually, we never use that sort of variation. We always look within region. So I'm not going to embarrass me with myself with my knowledge of within region differentials. I'm not going to say two cities. And then we're going to put, so we put region year fixed effects and a set of controls that kind of control for possibly different paths that depends on initial demographics. So here I'm coloring the controls based on their correlation with the initial mortgage rate. So if you see red, it means that they were negatively correlated with the initial mortgage rate. The green is positively correlated. Conditional region fixed effect. So it is true that places with higher mortgage rates have a lower population of blacks and lower population of natives. Conditional region fixed effects. And then we control for economic development, the state share of rural household, manufacturing wages, employment and establishment, and the amount of structures, how big the city was, how developed the city was. And then January temperature to control for amenity shocks. And then a lot of stuff that has happened during this period to control for possibly heterogeneous incidents of the Great Depression. And thanks very much to Bryce because all of this stuff you gave us because otherwise we wouldn't be able to use it. So this is the event study. Across different sets of controls, I'm plotting here the change on home ownership in a city that had a 1 percentage point higher mortgage rate within its region, let's say, relative to the average city. And what you find is that home ownership increases and stays stably higher in 1940, but this persists in 1950, and this kind of debate is quite robust across all of these sets of controls. And so in this way, we extend what the micro evidence has taught us of affordable mortgages, how they translate to home ownership. But what I think is puzzling about this is that here, again, because we're using this city level variation, everything can adjust. Prices could adjust, construction can adjust. And so it is pretty, sorry. And then if you look at this change in home ownership, and you define it by demographic, it's all concentrated in whites and it's all concentrated in 30 to 39 years old, mostly 30 to 39 years old. This happens to be also the demographic that sees the highest rise in home ownership in the aggregate between 1920 and 1930 and 1960. And the fact that there is no effect of non-whites is that's a very unfortunate aspect of these policies, but unfortunately we know that these policies were quite biased across racial lines. In some sense, it is a very unfortunate falsification test of our results that we don't find any effects on non-whites. What I found surprising about this is that this link between affordable mortgages and home ownership survives despite prices can react. And this is puzzling in light of work on modern setting. If we take Guren and Greenwald's estimates, their work kind of uses a variety of identification strategies that are present in the current literature on effects of cheaper mortgage credit on using the recent GFC, pre-GFC boom. And they find that when mortgages become more affordable, the thing that changes is prices, is not home ownership. The Goethe and Raher find that the effects on prices are 85 times larger than the effect on prices on home ownership. So it's just the elasticity of ownable homes is very, 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 very small. Yet what we find is the opposite. We find that home ownership moves a lot. And so to shed a bit of more light on prices and quantities together, we look at data from Lyons et al. That give us prices and rents continuously for 24 cities in our sample, and we had permits from the BLS. These results are all robust through using census valuations, but there's some caveats to how you construct prices there. Yep, done.
Data on construction costs, there was some discussion at the time of kind of.
Yeah.
DA and FHA, I mentioned this in, one part of my paper, it's kind of, that they enabled building techniques that were kind of, allowed lower out costs.
Yeah, so we tried with the permit valuations. So when they file for a permit, they should say what is the cost of the building. So we don't find any returns to scale there. Like, so we tried this regression of saying, okay, does the average cost goes down? We do not find it. I do think that's just not good data also. So we cannot just shed light too much. And the reason why it's not good data is that they were self-reported and the builders were taxed based on what they reported. So, and there was not a very good way of saying. So anyway. So this is what happens to prices and quantities using that data from Lyons et al. So here there's 24 cities now, and I'm cutting cities based on whether they have initially high rates or initially low rates. And what you find is that, of course, there's a big aggregate cycle, but they were roughly on similar trends, and prices are a little bit higher. They end up on 0.10, 10 log points higher in the high rate cities than in the low rate cities, but quantities double. The scale of the axis here is the 5-year moving average of permits. Quantities really expand much larger in those initially high rate cities that have seen this increase in demand. And if we do it in the event study sort of way by adding controls, we see that actually the effects on prices go back down, whereas the effect on quantities still stay particularly strong. If I do price rent ratio, so this is kind of the price of owning relative to renting, that's also completely flat. So this is the thing you want to look at when you think about a shock to mortgage rate. This is the thing that Guren and Greenwald look at. It's kind of flat over time. So there's no increase in the price rent ratio. Sarah? Yeah. Yes.
So I guess right there is this housing being obviously that happens.
Yes.
Show us a little bit here. Exposed only in the prices.
Yes, so that's a great question. So the fertility results, we're going to use this sort of variation across cohorts. For these results is aggregate results. One thing that I think these things kind of, one thing that I want to highlight is these effects persist way after the boom and bust cycle, the boom and bust rebound. So it cannot be explained only by vacant homes, because we do see like supply of new homes that is essentially higher. By using these prices and quantities, what we could do is we could just, precisely estimate the elasticities of supply, because we have a demand shock that is shifting the demand curve, and so we can look at the elasticity of supply. And what we find is that 10-year supply, so this is the supply of ownable homes, which could be from new construction or from flipping renting to owning, the elasticity is more than 2. It's around 2, and as a benchmark, Guren and Greenwald in the model period find 0.3. So the elasticity in the 1950s was 7 times higher than the elasticity that we would find here based on these estimates. And it's not only elasticity of ownable homes relative to rentable homes, it's just elasticity of homes overall. These cities were just expanding their housing supply. The first line is the effect on prices. The second line is the effect on quantities. What you see is that the first line is always not significant. And so in a sense, we really find quite much larger elasticity than what we find today. Yeah.
The ratio is not changing. Maybe you wonder about, did anything change in access to loans for developers who want to build rental?
Yeah, so that's kind of, I guess I would bunch both your comment and Dan's comment in a comment which is like, what if these policies also shift supply? And that I think is a fair point, that it could be that you could have a bundle of policies that were also shifting supply, either because there's some economies of scale or because there's some loans for developers. There is evidence, especially for the 50s, that the FHA and VA loans are doing that. It's not clear whether the spatial variation is exactly correlated with our variation. So for this to kind of makes a kind of bias our estimates, it should be correlated with the spatial variation. But it's possible that there was some effect on kind of making supply itself, like improving terms for supply. Yes. So this is coming all before the veterans. So that's kind of what makes me confident that this is part of it is just a shift in the demand curve. And that's why I think it's useful to have elasticities over different time horizons, is exactly because there's different caveats to different periods, and so I think over time horizons is kind of more convincing. Yeah.
Sitting around and you can say, well, I guess I'm surprised you add in work period when euro, you get a bigger, you get a bigger supply system there. I mean, again, it's kind of post-war, you kind of mix those two together, but I guess I'm surprised that, that you get a bigger supply system.
Well, it's also a longer horizon over which you can the supply can absorb the shock over a longer horizon. So a possible criticism of this is actually that where we're capturing supply elasticities at long horizons. Perhaps the supply elasticity that is relevant for policymakers today is the supply elasticity over 2 years. The problem of this setting, of course, is that over 2 years you have the problems that you're saying, that there is vacant homes. And so I think overall, I don't find it particularly surprising that the supply elasticity goes up over time. So the last part kind of goes, yeah.
Axioms might be forced to tell their property move out, anything that might affect you,
So we always use, yeah, no, that's we should look at it. We haven't.
I don't know how many cities that you get, but on the house supply the next.
Yeah, yeah. These are the 24 cities. Yeah, we should definitely look at it.
So I just have a question about quantities of these.
Yeah.
So there are two, I mean, there are people who live in rental housing before 1930 or 1932. And it is, how much of this is the conversion of existing structures from rental to home ownership as opposed to new construction?
Yeah.
Can you distinguish that?
I think that's what we try to do. I got a bit fast, but that's what we try to do between 5 and 8. So quantities in 5 to 8. So these are like use different quantities and prices. So 10-year supply is home ownership rate is the quantity. So how much people live in ownable homes, and the price is the price rent ratio, the price of ownable rooms relative to rentable rooms. And then in housing supply columns, the quantity is log housing units. So that's, we did it exactly like that. We did it exactly because we wanted to kind of shed light. Whereas today we find that not only the elasticity is low, but there is no effects on new housing units. But at the time, I think what these results show is that a big shock to mortgage, a big credit expansion was met with a robust supply response. If we repeated this kind of experiment today, I'm pretty sure we would get very different results because supply is so inelastic. Carol?
One thing that has nothing to do with your housing supply.
Yeah, well, we know that it's a lot higher, but we don't actually have evidence that it was. We know that it's a lot. We know that it's low, but we don't actually have evidence that it was higher back then. And I think that's the thing we want to contribute. Like we want to contribute evidence that there was elastic housing supply, using a demand shock that effectively identifies elastic supply the way that we do it today. Yeah. I mean, it's just like people just say a lot. Housing is really inelastic today. It used to be that we had a lot of housing supply. I don't think we have an estimate of the elasticity of housing supply. I guess that's the claim that we would make, and that's an estimate, which is pretty high. I guess that's where. Yes, but we don't know what are the consequences on housing supply. Like we didn't do the link. That's I think the way I would kind of argue. So the last part is kind of relating the fact that mortgages become more affordable, whether and young families could afford their homes, their homes earlier in life, and also larger homes being more affordable. So we want to ask what are the effects on fertility. So I'm just going to walk you through quite quickly on what is the identification that we have behind this, which is that we're going to compare two women, one who was born in Boston in 1890 and another one that's born in Dallas. And here we're plotting the mortgage rate that these two women would experience over their life if they stayed in the city where we observe. And so a woman that was born in Boston in 1890 faces roughly an interest rate that is 5.8% over her child age. So we take the average interest rate during the fertility window, it's 5.8. You take the fertility rate, the mortgage rate of a woman born in Dallas that does their fertility window in Dallas, and that's kind of 8%. However, by 1920, these two women, the two women that a woman that born in Boston and one that born in Dallas, actually now face the same interest. So that's exactly the variation we want to use in trying to understand whether mortgage rate exposure affects childbearing by using this variation across cohort and across cities. So this kind of goes into Sarah's point of like trying to look at really the cohorts that were exposed to this thing rather than just the aggregates. So the thing we do is, well, we take a mortgage outcome that is the rate experience, we can difference it with respect to an unlimited cohort. This is kind of meaning we add the city level fixed effect, the fact that fertility in Boston can be very different from fertility in Dallas. And then we can take the change with respect to this cohort in Boston. Is well, this cohort that's born in 1920 sees 0.6 percentage rates lower, because just rates went down. But someone in Dallas sees 2.6% percentage rates lower. And so the definitive estimate between these two cohorts is that a cohort that's born in Boston relative to its initial cohort, relative to the same difference for Dallas, sees a 2 percentage point lower. Now you do this for all cohorts, and you have a definitive estimate that is traced by the initial interest rate interacted by cohort fixed effects. And then we have a second stage outcomes, the number of children and the inferred children at home. What's good about this design, I think, is that we should see increasing effects over this time period, and then these effects should be plateauing. Because whether you're born in 1920, 30, and 40, at that point the shock has happened. It's a persistent shock. And so for the recent cohorts, we should see not only no pre-trends, but we should also see no post-trends, meaning that for the most recent cohorts, the effects should be plateauing. If it was that Boston and Dallas were on different trends, we would see pre-trends, but also post-trends. Like even after our policy happened, we should see increasing effects. And we have the same controls as before, but now we also have individual control for education and income. So here I'm doing the first stage. I'm basically repeating that black line, the definitive black line, which is that for a city that the 1920 high rate cities, this is the effects on women's fertility. And this is the effects of age at first cohort, birth. So the effects for this cohort follows exactly the type of exposure. Women that see their mortgage rates go down also have kids much earlier, and the average estimate of this is 0.75. So all cohorts and that see their mortgage rate go down start having kids earlier, exactly to the same degree as they see their mortgage rate go down. Just 1 second. And then if you do age at first, oh, I'm sorry, I swapped the caption. This is age at first birth, and then the number of children is on the right. Those women are also those women that see more children, exactly in the same pattern as the mortgage rates happened. Indeed, if you take the cohort exposure coefficient against in the first stage, so how much is the mortgage rate exposure, and the second stage, how much their fertility outcome change, you see quite a strong pattern for which this cohort that relative to the average cohort saw a mortgage rate go down by mortgage rates go down by 0.5, add 0.03 more kids. The average implied estimate of this is that for a 1 percentage point lower mortgage rate, you have 0.13 more kids, and you have kids 0.76 years earlier. Daniela?
Like compared to like modern estimates that we have of like the access to, more house, like
Yes.
on fertility. And also relative the size of that relative to something like the baby. Because it looks big, but I don't know how much.
Yeah, no, it does look big to us too. It's actually not easy because the best estimates we have is like a housing lottery from Fazio et al. In Brazil, but that's just a lottery. We don't have a dollar value. This is the good kind of one advantage of this is that we have a dollar semi-elasticity. Like mortgage rates go down by 1 percentage points. I kind of know that is roughly 2% of income for families at that point. But this is also for 25 years. So we don't have these sort of shocks for 25, because this is throughout your fertility window. So it is big, but it's also a shock that is persistently throughout your fertility window.
A few minutes.
Yeah.
How plausible do you think it is that the only channel is interest rates?
I don't think it's that interest rates affect fertility per se. I think it's because they enable home ownership.
Yeah, no, I just mean for the scaling.
I guess I wouldn't take that semi-elastic, no, yes. No, exactly. No, no, no. So thank you. This is quite useful. I would not take the semi-elasticity as, even though, of course, that's kind of one of the things we highlight. We do not see of it as like, this is the semi-elasticity that I would give a policymaker on what happens to kids if you lower policy rate by 1 percentage points. The main reason is that I would think prices would change today and so you wouldn't see anything actually on ownership. It's just a boon to homeowners. And then the second reason could be that the elasticity of childbearing to housing costs at the time could be different for cultural reasons than today. I think the way we see it is that this was a roughly big effect on fertility that links the idea that homeownership suggests that homeownership is good for fertility.
It'd be interesting to look at other effects too. I mean, look at effects on it. I mean, there are a bunch of different ways.
Yes, yes.
Some that themselves would be chance.
Yeah.
I think those are interesting in themselves.
Yes, yes. Okay.
At the age of first home purchase?
No, because the census doesn't have home ownership in 1950. It was digitized on the back of the form and they just thought. Oh, yeah. Nice. Nice. No, thank you. That would be great. I'm gone. So let me conclude. We create a historical series of mortgage conditions for more than 2050 economic cities. The first part documents and explain the convergence mortgage interest rate. And I think this is kind of the end estimates we end up with. Thank you so much. It's been like really fun.
Yeah.
And I were saying the other day, like, the speakers should take over the bell and begin with this.
But then you have to take it away like immediately after.
Exactly.
Okay, hi everyone. That's a senior colleague mentoring right there. So thank you all for being here on Macro Morning. This is a paper joint with Chenzi. And we're going to be thinking today about the finance growth nexus. And so one of the things we think is central in thinking about the link between finance and growth is the idea that we want to design a financial sector that is good at allocating credit. But this is DAE, you're economic historians. You know that we don't just magically have good institutions or good regulation, right? There's a lot of path dependence in the design of both of those two kinds of structures. And in the context of financial regulation, we think about these things, these kinds of persistence as coming from the fact that bankers are really good at organizing themselves to influence regulators and change the kinds of regulation that we have on the financial sector. So you might think about crises as a window of opportunity, right, for breaking this persistence. And we just saw in Leo's paper that in the 1930s, the US mortgage market is in such dire straits that the US government steps in and fundamentally changes how we actually conduct mortgage lending in the United States. So crises could be this kind of way to break the institutional setup that we have in financial regulation. But there are also so many examples in US history and globally, right, of incumbents realizing in a crisis that they're valuable, they're special, and they use that leverage to lock in advantages. So that if we want to think about how we find our way to the finance growth nexus, we know that we often are going to have to change the trajectory of our financial regulation. But the question is, are crises helpful or hurtful in getting us there? And that link between regulation and crisis is going to be the focus of our paper. So what I want you to think about is a crisis is going to be more severe the harder it is to replace the banks that are exiting or not conducting lending. So in that case, crises are going to be exacerbated by regulation in the sense that when we're really good at establishing barriers to entry, we protect our incumbents, it's going to be really hard to replace banks, right? So the higher the barriers we have before the onset of the crisis, the longer the crisis is going to endure, all else equal. Now, on the flip side, the severity of the crisis is also going to influence the path of regulation going forward. The higher failure risk is, the harder it's going to be for banks not to argue for protection, right? They're like, help us, help us, help us. But at the same time, customers are going to be asking for reform because they would like access to credit. So the path of regulation after a crisis is going to depend on these relative weights between incumbent protection and credit access. So what that means is that there is this joint determination of regulation after a crisis where we should be thinking about pre-existing regulation and the crisis itself as shaping the regulatory equilibrium that we end up in after the crisis. Now, this kind of feedback loop is going to be really important for understanding the recovery from financial crises and the determinants of financial regulation or good regulation more generally. And so that's going to be the focus of our paper today. We're going to move in 3 steps. I talk very quickly, so we might get through all 3. We'll see. So the first thing we're going to do is a case study looking at the state of Illinois. And this is going to provide the first direct evidence linking voters' preferences on their own regulation to banking market dynamics. So the nice thing about this is that we actually are going to be able to observe how the communities affected by regulation evolve in terms of both their banking markets and their preferences over future financial regulation. So we're going to see all of that in one closed ecosystem. Then what we're going to be able to do is expand to the entire United States. We're going to collect the same kinds of regulation for the whole United States, and that's going to create the first panel on banking market, state bank costs for the whole US at the city level. Now, this is going to be important because it's going to give us variation within and across states in bank entry costs based on city population, which is like the cornerstone of this kind of regulation. I'll get into the details of that later. And that's going to give us a couple of facts on how regulation evolves alongside crises. First, in the 1920s, there is a lot of legislative activity, right? When what's going on usually is that bank entry barriers are going to be rising to protect incumbents. This is going to come at a cost, though, because after the 1920s are the 1930s. And we show that the communities that are most affected by these kinds of regulations have the largest declines in bank market access. So to put this another way, what we're showing you is that this joint feedback between regulation and crisis is going to lead to a more severe local Great Depression if there is no reform. And so we end up also linking this to the reform that happens in the 1930s. Now, after these 2 decades of legislative activity, the window snaps shut, okay? And that's actually going to be consistent with our emphasis on the combination of earlier regulation and crises determining regulatory change, because after the 1930s, we don't see these regulations changing again until the shocks of the 1970s. Okay, so you should be thinking here that what's going to happen is the kind of regulation you end up adopting by the 1930s creates the kind of incumbents that are going to survive until the 1970s. You're either in a unit banking state of the world, or you're going to have branch banks. And in other work, Chenzi and I show that this kind of regulation shapes decades of economic development. All right, let's talk a little history. So I want to emphasize here that we're going to be talking about state bank regulations here. So states are the primary regulator for most banks in the US in the interwar period. We are going to be talking about differences then in laws across states. And the nice thing about this is that we're going to have variation within each of the big national economic, banking, whatever shocks that are listed at the top of each of these graphs. Okay, and so what you're going to see is that in the 1920s, on the left, that states are passing lots of bank entry laws. Or bank laws. So we collect all of the state banking laws that states pass over this period, and you can see here that legislative session by legislative session, they are passing hundreds of laws. Right? Lots going on. It's gonna increase in particular in the New Deal period, and this is going to be mirrored on the right by what's going on with the bank suspension rate nationally. The 1920s are a period of financial instability. It would look really bad relative to a lot of U.S. history, but the thing after it kind of dwarfs it, right? And so after 1929, there's going to be this huge spike in bank suspension rate, in the bank suspension rate before it falls again. So we want to try to understand the link between these kinds of regulations and these different severity of crises, right? The 1920s versus the 1930s. So if we want to understand this link, we're historians, we read a lot of primary sources, and from that, we kind of gather 2 motives for how it is regulation and crises are going to be linked over this. So the first is going to be incumbent protection. I know, because I've been sitting in the back, you guys absolutely cannot read this, so I'm going to read this. The first thing is that we can think about creating protections for banks because they're community institutions. So what I'm showing you here on the left is a publication by the American Bankers Association from 1921 called The Banker Farmer. And what they're pointing out is that if you have a bank in your community, it's going to build citizenship, cooperation, better schools, better roads. So they're trying to give all these reasons like protect us, protect banks. We're so good for you. But most of what they're going to be talking about is operating through the lens of credit. Right? You should care about having a bank in your community because it's going to smooth local shocks. So if you're having a bad time, like we as the banker will be there for you. Yes, Naomi.
Okay, but I'm thinking about Eugene's work on regulatory arbitrage, and there's a lot of legislation in this early 20th century period, which is geared to promoting state banks and federal banks, which has a very different effect from incumbent protection.
Yes. So for context, so in the period basically up through 1920, there's this kind of race to the bottom in bank entry regulation. And what that's going to do is that by 1920, almost every county in the US is going to have a bank, right? And so one of the things that we're going to be talking about here is that there are actually going to be incumbents. And so the sort of the rise and fall of regulation that we're going to be talking about is going to be happening once there actually are entrants. We're going to have variation in those entry requirements. So I can show you that when you raise and lower things, you're going to get things that look consistent, results that are consistent with this. So absolutely, that's something that's going on before this in particular. Now, credit access is going to be kind of the main motive here. I'm quoting the Comptroller of the Currency, so one of the main financial regulators for the United States, as saying that unit banking and community banking is the institution most representative of the genius of the American people. I didn't survey you to ask if that was your guys' number 1, but this is what we're working with in this period, right? So both bankers and regulators are like, what's really important? Having a unit bank, right? Having a bank in your community. But as bank risk starts to rise, there are going to be costs, right? There's going to be backlash. So over here on the left, this is a political cartoon from an Oklahoma newspaper from early 1933. And what I'm showing you here is that banks literally have under their thumb farmers, industrial workers, and merchants. So we're now being crushed by our community bank as the disapproving ghost of Andrew Jackson looks on. Again, this is going to be articulated through the importance of credit, right? And you're being alienated from your community bank because they're not there for you when times are worst. You can see this in a quote from a rural Georgia newspaper in 1931, where this is a notice of bank failure in the newspaper, and they say, look, conditions are bad. We've messed up. And so what we should be thinking about here from these kinds of sources, you see this across many different newspapers and many different things, those are just some examples, is that crises are an opportunity for changing regulation because they are a moment where we see the downside of incumbent protection, right? We realize that there are costs to our existing financial regulation, and we articulate those costs through the change in credit access. All right, so let me talk a little bit about the data. So we're going to collect a whole bunch of data for this project. First thing I want to talk about is our regulation data. So what we do is we go back and we collect all of the state all state banking laws over this period. But in particular, we're going to be thinking about bank entry regulation. So we're going to go and get all of these laws for all states and all of their different clauses and conditions from 1910 onwards. So that's going to give us a way to understand what the entry requirements are for every place in the United States over this period. Now, what's going to be really important for this is that these bank entry laws are going to be a step function of city population, okay? So we're going to collect all of these various step functions, which means we need to know, for example, for communities of 3,000 or less, you need $25,000 to open a bank. So we get the 3,000, the population threshold, but we also know that it's going to cost $25,000. Once you have more than 3,000 people, that the amount of capital that you need to open a bank is going to increase. So we're going to collect all of these laws, and then we're going to go recover the population thresholds for everywhere in the United States from the full count censuses. Okay, so for all incorporated places, we know exactly how much money you would need in any given year, because we have the stock of laws, to open a bank. And so what that's going to give us is variation in local entry costs. How much does it cost to open a bank in your town based on the distribution of city sizes within and across states? Okay, so yes, Paul. Prohibit exit from banking. So one of the things that's going on in this period is that regulators complain that they can't refuse charter requests. So they're not going to be able to say, like, when people say, I'd like to open a bank, please, they're going to be able to open it. Yeah. I don't think so. I'll have to think about that. I don't think so. Corolla? Yes. The short answer is that we're going to look at banking market dynamics at the city level. So we're going to see if there are monopolies, the changes in competition, and all of those things. And I'll show you the results of capital requirements on those things. So we look at that. Eugene? Yes.
If you look at the National Bank index, these sort of measurable restrictions are few. Most restrictions, most are in governance, which is much more difficult.
Absolutely.
Deal with those issues.
Yes.
How many you need to, for example, to have a list of all the owners of the bank, as the example, all these sort of things, reliability, all these issues with really subtle aspects of control governance.
Yeah, so there's going to be a lot of things that are going to affect how banks operate, and a lot of these things are going to be happening on a statewide basis, which is a lot of what Eugene is talking about. There are a lot of conditions for opening a bank. And there's going to be a lot of changes in macro conditions that are going to be happening over time. The nice thing about having city level panels is that we're going to have variation within states over time. So some of these kinds of requirements are going to be the same for everywhere in the state. We're going to be focused on the step function that is associated with population. So you should be thinking about what's changing as a function of bank entry barriers through capital requirements, which I'll talk much more about later, as opposed to these things are going to be fixed across the state. And then because we're using this sort of within time variation, we can difference out the fact that there are going to be these macro conditions like inflation or any of these other things. Okay, I want to talk a little bit about the preference data because this is a cool thing about the state of Illinois. So most of the time in political economy, we don't actually observe how people feel about the regulation that the people who choose regulation, how they feel about changing it. So a lot of the times what people are going to do is look at the effects of legislator votes or maybe your votes for a political candidate. But both bills and votes for candidates are a bundle of issues and may be subject to thinking about things like lobbyist inference. So we can't actually usually identify how changes in preferences change the specifics of changes in regulation. Here in Illinois, we're going to leverage the fact that they did a cool thing in their state constitution where the voters had to approve every change in bank capital requirements from 1871 until 1940. So what we're going to do is we're going to we figure out what all of these changes are, right? We collected all of the laws, and then we're going to be able to see changes county by county in votes for and against changing bank entry barriers. And because we have the laws, we know whether the laws are changing the entry barriers in your community or not. So we're actually going to be able to observe your preferences on your own regulation, which is going to get rid of some of the identification problems that we would typically have in this kind of scenario. Now, Carola, to your point about trying to understand what's going on with bank market dynamics. So in the context of Illinois, we digitize all of their banking directories from 1917 through 1940, and we link them to each other. And so what that's going to let us do is observe how banks are entering the market. Are they merging? Are they exiting, right? So we can think about changes in bank market access, which is going to involve some of these changes in competition. Also related to that, most of what we're seeing is that people are establishing monopolies. And we're thinking about how long these monopolies are going to change. So that's going to help us understand the role of incumbent protection in shaping these kinds of laws. So we do this for states, and then we use the national bank data that other people have very generously provided. And we're going to do something similar then when we go to the national level, right? So we're gonna do two things. We're going to talk about what's going on in Illinois, but we're also going to talk about what's going on in the rest of America. And there we're going to use county level data to do something similar to think about changes in suspension and the number of banks, whereas in Illinois, we know exactly, because we know exactly what bank is doing at any given moment, we're able to think about all of the sort of the dynamics underpinning these changes. Okay, I want to give you guys a sense as to how we're thinking about this link between regulation, preferences, and banks. Do you have a question? Okay, all right. I was ready. All right, so we have a very simple framework for you here. The paper has a model, but I think everyone loves a flow chart. So today we're going to be thinking about this combination of effects. So what I want you to be thinking about is the idea that banks are able to shape their own entry barriers, and they're going to be pro having barriers to entry, right? They want to sort of deter competition. And when times are good, regulators are also going to be in agreement with this, right? One of the things that's going to be going on is that regulators are saying, well, maybe competition is a bad thing. So if you're able to guarantee credit access, you know what? That's fine. That's fine. Let's allow there to be difference. Let's allow there to be some sort of barrier to entry. I think the closest that we're going to be getting to think about political capture is in an Illinois setting where people are voting on their own regulation, and there we see something that's about your own. We're going to see things that are consistent with the idea that you're thinking about what's going on in your own market, and they're not saying changes necessarily. Yeah. Yeah. I'll have to think if there's anything more we can do on that. Yes, absolutely. Absolutely. One of my favorite senators, William Gibbs McAdoo, is a prime example of that. We could talk about that later. But here again, what we're doing is we're thinking about variation at the city level in exposure to these things. So so we think that's going to help us identify something that's much more likely to be tied to changes in entry barriers and banking market dynamics. Sure. Okay. Yeah. I'll think about what we can do. So think about what's going on beforehand. Ex ante, we have some sort of barriers, and then one day we wake up and there's a crisis. I know every day is a crisis, but like, let's wake up and there's a crisis. So let's talk about what happens in that situation in terms of the evolution of regulatory reform. So if there is a severe crisis, a lot of banks are going to be at risk of exiting. And that's only going to create a more severe crisis if it's hard to replace those banks. So what that means is the combination of we woke up and today is a really bad day, and we have high entry barriers that we're not going to get recovery here. So this is about thinking about the recovery from a financial crisis is operating through whether or not we can actually restore credit access. Now, when banks are failing and they cannot be restored, we're both losing the incumbents who are going to fight for protection, and we're angering customers who are like, you know what I would love? A loan. Right? And so that coalition that was sustaining our prior equilibrium is going to go away, and that's going to create the circumstances for regulatory change. Now, if we live in a world where entry barriers just aren't that high, or the crisis isn't that bad, we're going to end up restoring enough credit access and having strong enough incumbent, survivorship that we stay in the status quo. So we want to think about there being these differences between the intersection in pre-crisis entry barriers and the severity of crisis as being the thing that generates change, because otherwise we don't really see a need for changing how we're going to continue to regulate. So that's going to be the channel here that we want to be thinking about. Yeah.
Let's severe don't survive you strengthen the barriers to entry. But that happens in federal regulation. These components survive, which really strengthen the barriers. So
yes,
it was the most severe crisis.
So they do, in some sense, in the 1930s, strengthen the barriers to entry, and they also create new ways, right, to protect themselves. You should like thinking about who was in support of deposit insurance, for example, within the 1930s versus who wasn't. Small banks loved it. But what we're talking about here, again, is the entry requirements for most banks, which is state legislation, right? So I don't disagree that there are a lot of things. The Great Depression, crazy time. But we're thinking about here the changes in state bank entry requirements that are going to be changing within states differentially over time. That's how we're going to be able to identify our mechanism. I want to give you guys a little bit of a sense as to what those tools are. I kind of have already said this, but I know that not everyone like eats, sleeps, and breathes bank regulation. You should try it. But we're going to be thinking about two tools. So the first is going to be thinking about the price of banks opening, which is called the capital requirement or minimum charter capital, something along those lines. And it's basically the price you pay in order to obtain a charter. Now, this is an entry price. So you should think about the fact that as the cost of entry goes up, it's going to be more expensive to open a bank, and that should reduce the number of banks that are going to be operating in any given market. And that's going to be a way to protect incumbents. The other way we can think about changing bank entry regulation is by thinking about bank branching, which is the number of offices that you're allowed to have. Most states in the 1920s are largely going to prohibit bank branching, so most banks are going to have a single office. Nobody's really operating across states. It's a different time than it is today. But there are going to be changes in how people think about this regulation. So let me give you an example here as to how crises are going to be interacting with regulation to start changing people's minds. So this is from, again, a rural Georgia newspaper. The Somerville News was a rich text, and I learned a lot. So what I have here on the left is a quote from 1927. So the box in orange is a notice that a bank nearby is closing. And they're like, God, all right, business will inevitably be dull. They note that, honestly, pretty high capital in rural Georgia in 1927. And they're like, we don't really know what's going to happen with the bank. Fast forward 4 years. I didn't have to do anything. This is like the, the time where you're like, the text is actually the text. This is the front page of this newspaper. On the left in the blue box is a pretty aggressive screed saying we need branch reform in order to save ourselves. We have to liberalize the law. On the left, or sorry, on the right are 2 news articles. At the top is a notice that the bank in this town is failing. And underneath that, in the orange box, is a complaint, that wheat is plentiful and money is scarce. So you can see that, like, we have a bank failure in 1927, where people are like, well, this, things are going to be dull. I don't know. And then by 1931, this newspaper is like radicalized, and they're like, we need branch reform. Everything is terrible, right? And that's one way to think about how crises and entry barriers are going to interact to create change, and they can actually shift these things. Okay, a lot of hands. I say Naomi, Josh, Eugene. Yeah. Yeah. Yes. So one of the things that happens in 1928 is that, so in 1927, you were allowed to have bank branching in Georgia. In 1928, they got rid of it. Yeah. All right, Josh. Yes, but again, so I don't want to say that money doesn't matter. That'd be a big claim. I would like to keep my head. But again, the thing that we're going to be leveraging is the fact that there's going to be variation in those costs within a time period. So I acknowledge that those things are absolutely going on, and I think those things are important. But that's not the kind of the approach that we're going to be taking. Yes. We'll get, yeah. Yes, I'm going to show you evidence on this when we get to Illinois that it's new. You haven't seen it yet. Where's a hand? Yeah. Yes, and I think so. This gets back to Corolla's point in particular about one of the things we see when we look at national banks is that they use this opportunity to entrench, and so it's sort of their own monopoly. So these banks are not going to get big in the sense that we think about it, because again, you're basically going to be allowed to have one office in most cases. And I'll show you that most of the time that's what's going on is you allow one bank to enter, and that's it. Yeah, Naomi. Yeah.
Because you've got one newspaper here, and it could be that the other newspaper across town is taking exactly the opposite of opinion.
Yeah.
And the fact that in 28 they got rid of branch banking in
Yeah.
the state suggests that there was already a lot of differences of opinion.
Yes. So this is, I'm sorry to cut you off. So what I'm going to show you is we're going to move to the Illinois data in like 2 slides, and I will show you that these motives dominate by looking at these changes in votes over time. Right. They do not. But we're able to look at these changes in capital crimes. Then when we look at the entire United States, I can show you the link between regulation and access in a way that should be consistent with this. I'll show you all the laws and all these things. There's a lot of variation, and we're going to, in the timing of these things, the amount of the regulation, and we're going to use that to try to show you that our hypothesis is what's going on. Leo.
For branching because they felt that they mutual side with the back. So that's another way in which classes can be affected. That's branch. Really like that. It's not about having a it's another challenge which classes.
Yes. So that's again, I'll have to think about this. I don't think that's what's going on here, because you're more worried about the fact that someone could be coming in from out of town if you legalize bank branching, as opposed to thinking about it maybe as an insurance mechanism for yourself during the crisis. Okay, I said that we were going to talk about Illinois, so let's talk about Illinois. So the way that we're going to be thinking about this, I'm going to show you in a second the actual local exposure and state laws and the step function and population that I've been talking about. And we're going to the nice thing about Illinois is that we're going to see all of the different aspects of our framework in the same place. Okay, so what we're going to do, I'm going to show you what this local variation in state laws is that I'm saying gives us this within state variation. And then what I'm going to do is we're going to trace our way through how changes in these referenda, right, changes in regulation are a function of your own implied changes in capital requirements. Then I'm going to explain that by looking at changes in market structure and credit access, and then show how, again, it's going to end up closing the loop in changing your opinions on voter access. So we're basically, I think this is a circle diagram. We're gonna do the whole circle of life here across different levels of aggregation to help validate what we're doing. Yes, Danielle. So this is cool. The state legislature has to pass it, and then they put it on the next general election ballot. And so that's going to be so that's going to be where it comes from. So you have to have it pass, and then it has to go to the next general. So the dates that we're going to be looking at are the general elections in which people are voting. Okay, so let's talk step functions. So what I'm showing you here is the state of play before these different referenda. So in 1918, bank minimum capital requirements are going to jump discontinuously at city populations of 1,500. So if you have under 1,500 people, you need $15,000 to open a bank. If you have more than 1,500 people but under 5,000, you're going to need $25,000 to open a bank. And then that number is going to keep jumping at 5,000, 10,000, and 50,000. So you can see here how population is going to discontinuously change your ability to open a bank because there are going to be these big jumps in how much it costs to open that bank. Now, these step functions go a little nuts over the next 20 years. So we're going to be looking at 1920, 24, 30, and 40 as our 4 referenda here. And the point of this graph is to show you that bank capital requirements move around a lot in the 1920s and 1930s. And the amount that they change is pretty gigantic. For the smallest communities, bank capital requirements are going to jump by a factor of 5 between 1920 and 1930. So there's a lot going on. Yeah, Price. What's what I'm about to show you? I love the enthusiasm. Let's talk about it. Okay, so Naomi was asking, how are people's, are these things, why are these things changing? How complete is this? So it turns out there are 102 counties in Illinois. Chicago is one of them. And what you can see here is the share of counties that favor higher entry barriers across our 4 referenda. So in 1920, support is quite low. It jumps up to 71% by 1924, which almost halves again after the Great Depression has started, and then falls again to near 0, but not 0 by 1940. So you're going to see there's a lot of time variation in how counties are going to be, whether or not counties support having higher entry barriers, but then also within each referendum, we're never in a place where it's unanimous consent. We're not ever all on the same page. I'm not from Illinois. Maybe that's consistent with everyone's preferences that no one's on the same page, but we're going to be thinking about this here as a test of our theory. Eric. Yeah.
Barrier increase passed, but you're saying only 43.1% support. So this is not population weighted, I guess.
This is not because correct. Yeah. So you're right. If Chicago wants something to pass, pretty big. But here we're going to be thinking about what's going on in terms of counties' own preferences on their own regulations. Yes, Eugene. Yes, that's how we got this idea.
There was lobbying by the State Bankers Association. They actually paid ads. They did all this. It wasn't voters just simply thinking about that. They were like any business. They're busy trying to.
Yes.
So do you have data on that from all of these to see what the influence of the Bankers Association is?
So that is a really interesting question. We don't have evidence on the amount that they're spending in a way that's correlated with differences across counties and their capital requirements. So the amount, what we're going to be doing when we test this is a simple diff and diff where we're going to have county fixed effects and election fixed effects. So the amount that the Bankers Association is spending in any given election is going to be differenced out by the election fixed effect. Anything that's different about counties, it's also going to be differenced out. And we're going to be focused here on our 2 betas. So here, remember, we know exactly what the capital requirement changes implied are in these referenda across these different places. And so we're going to be looking at how the implied change in capital requirements in the 1920s non-crisis, versus in the 1930s, crisis, affects your support for changing capital. So that's going to say, if this is going to raise my own capital in the 20s, am I yes or no? Versus in the 1930s, am I yes or no? And what you can see is that in the 1920s, people are like, let's do it. Let's raise the barriers in my own community. I would love to do that. And that's going to be strongly positive, significant, all that stuff. And that's going to go away in the 1930s. In fact, it's going to be negative. Those same communities are like, please stop. And you're going to see those same things if we control for political variables, agricultural variables, any of those things. I'm going to let Naomi, she raised her hand. Turnout is not changing as a function of this. I've done that as an outcome. So we know exactly the votes. Yeah, it's not, yeah, so it doesn't change. Eugene? Right. So we see exactly the vote on this particular part of the referendum, which is only about capital. And then we're showing you that your support for that change in raising capital is tied to whether or not that capital change would be happening in your own community. All right, so next what I'm going to show you is that this turning point is really being driven not just by, is it the 1920s versus the 1930s, but rather, am I experiencing in this moment a credit shortage? So now we're making this a triple difference where we're adding an interaction between not just the implied change in capital and is it 1930, but rather, did you this year experience an exit in banking? Did a bank exit in your town or your county in this period? And again, this is going to be strongly negative and significant. So what this tells us is that you are much more likely to change your mind, not just because it's the 1930s and you're depressed and capital requirements are too high, but rather, do they change in your community? It seems much more salient. Yes? Yeah. So we've done this just specifically for each year, and you'd still see that this is going to be true if you just look at 1924, for example, versus 1930. So this is going to be something that's consistent across election by election. Here we're pooling it just to make it easier to look at. Okay, so I've shown you that people change their preferences on their own regulation in the 1930s versus the 1920s, in particular when they've lost access to credit. But now what I want to do is show you that these capital laws are the things that are changing banking market dynamics in a way that is consistent with this trade-off between incumbent protection and credit access. So let me just visualize for you here the different referenda that we're really focusing on here, 20, 24, and 30. And there's going to be these capital requirements that are, again, tied to population. That's the variation that we're going to be using here that is going to be determining your local exposure. And then what we want to do is say, how much is this changing your entry cost? Excuse me. And what are the market impacts? So again, this is basic diff and diff, two-way fixed effect diff and diff. So what we're going to be doing is looking at, we have town and year fixed effects and what we're looking at. And we're going to say, how is the change in your own capital regulation changing what's going on in your banking market dynamics, holding constant year and town shocks. So we're going to be thinking about this beta as telling us when the law is in effect, what does it do to your banking markets relative to all of the other times? Okay? So the first thing I'm going to show you is that, to your point, people are asking, like, do these things actually matter? Like, what's going on here? When you lower capital requirements, you get more banks. It increases state bank access in 1920, which is when it should. But then when you lower capital requirements, you no longer get this effective entry. People are no longer entering into these cities. So the banks kind of, the law works as intended. A nice thing is that it only works when it's intended. These laws do not affect state bank entry, national bank entry. Those are a different set of requirements and a different set of thresholds. Nothing's going on with them. This is about the regulation changing what's going on with the banks. Okay, so let's zoom in on 1924. So here I'm showing you three different outcomes, which is about the transition and what's going on at the city level in banking market dynamics. The first is, does the city become unbanked? Do you go from having banks to having no banks in that year? Do you have a monopoly? and does it persist? So there's exactly one bank. And then are you unbanked today after being unbanked yesterday? And what you can see is that raising capital requirements in 1924, after we had facilitated all of that entry between 1920 and 24, leads to the establishment of monopolies that are going to deter competition. We have nobody's entering, and you end up, you saw on the last slide, and you end up keeping these kinds of monopolies. But if you lose access to your bank, it's a blip. You're able to replace your banks in the late 1920s. So these high barriers do not lower access, but they do what we said, right? It's the 1920s, things are like a little bad, but not that bad, which means that you are willing to protect incumbents because the disruptions in credit access are simply not that long, right? But then things get worse. The 1930s happen. And when we look at the effects of raising capital requirements in 1930 on the towns that are exposed to them, what we see is that you're much more likely than other towns to lose banking access. And a lot of that is coming from the fact that you went from having exactly one bank to zero. So protecting those incumbents kind of bites you as soon as the Great Depression starts. And this is a persistent state, right? Once you lose your bank in the 1930s, they're not coming back. So this is going to tell us that high barriers matter, right? And they cause these changes in preferences in part because you lose access to credit and you're unable to overcome the high barriers that you've established for yourself, right? So just kind of to put all of the Illinois results into one box for you here. What's going on in 1920 and before? Well, there are low barriers to entry, and that's going to allow banks to enter. And so we're going to see the spread of banking across Illinois, but that also creates incumbents. And by 1924, there are enough incumbents who are providing enough credit that we're like, let's raise those barriers. Let's protect the monopolies that already exist. And that's going to, as you saw, create monopolies and lower bank entry. But then after this, in 1930, it's a crisis, and the banks and those high requirements end up kind of hindering bank replacement. And that can explain the changes in preferences we see where all of a sudden the same communities are voting against raising their own requirements when there's a failure. Banks are not going to end up being replaced. And this is going to create more and more unbanked places throughout the 1930s, which can explain why we end up then seeing this reversal of these preferences by 1940, right? There's not a lot of incumbent bankers saying, let's keep the barriers, and actually it's a lot of people being like, please, may we have banks, right? That's what they're looking to do here. Okay, so let's talk about the rest of America. And so what I want to show you first is that in this specific way, Illinois is not unique. Okay, so this is the change in capital requirements across US counties in places that have capital requirements in 1920 and 1930, and also have incorporated places in the US Census in both of those 2 decades. And you can see the darker the blue here, the larger the changes. There's going to be a lot of increases in capital requirements that are quite scattered as we look across the United States, which you already saw for Illinois. But now I can show you that there's basically this shift outward of the bank capital between 1920 and 1930 across the United States, and then no changes to that thing really between 1930 and 1940. So capital requirements are changing in the rest of the United States, largely as they are changing in Illinois. Again, this comes at the same kind of cost that I just showed you for Illinois. It happens across the US. Okay, so now what we're doing is we're looking at counties over time, and we're saying what is the effect of raising capital requirements in T-1 on bank loss in time T. And so you can see that when we're not in crisis in the 1920s, there's not really any loss of banking. If there are changes, it's probably replacement. The number of banks doesn't really seem to change. But in the Depression, you start losing access to your banks, right? So we should think about bank regulation as shaping whether or not you have access to banks in the 1930s, in part because they're affecting your ability to replace what goes away, regardless of where that instability comes from. Okay, so it's not just the case that we can think about bank capital, right? There's enough instability and enough Sturm and Drang and all of these things that people are not going to just be thinking about bank capital, but rather the possibility for more stringent reform, right? What if we pass bank branching? So here what I'm showing you on the left is the number of states that pass a bank branching law in each legislative session. So those are 2-year periods, where the orange is going to be an increase in regulation. So Georgia, for example, increases their regulation in 1928 because they prohibit bank branching. And the blue is going to be decreasing the strength of regulation. Do you legalize bank branching? And you can see that 20 states introduced bank branching in 1933. That's a lot, but it's not everybody, right? So again, we're going to see that there's this incomplete reaction. People have a lot of different ideas about what to do in the 1930s as a way to get out of this. And in fact, if you look on the right at looking at whether individual counties are eligible for bank branching and their costs of entry, you'll see that there's not really much of a relationship in 1920 or 1930, but by 1940, there is a strong positive correlation here. Now, I should say the reason we have variation across counties is that the laws that legalize bank branching have the same kinds of like population requirements and local thresholds as the capital requirements. So when we look across counties, we can say what share of the population of the county is actually eligible for bank branching. And so what that's going to let us do is show you here that there's this rise in branching eligibility, specifically where bank entry costs are already high. And that goes along, again, with exactly what I said, which is that when you have higher barriers beforehand in a severe crisis, you're going to be much more likely to push for reform. Okay, and that's in fact what we're able to do in this piece of the analysis. So now what I'm doing is I'm using that county variation. Again, this is just a county year panel. Where we're predicting whether you increase the share of your county that is eligible for bank branching. So is there reform in your market as a function of whether you raised capital requirements beforehand, and if it's a crisis or not a crisis in panel A. So crisis, 1930s, non-crisis, 1920s. And again, you'll see that during the 1930s, having higher capital requirements to begin with pushes you towards expanding bank branching. Okay, and this is going to explain roughly half of the expansion that happens in branching in the 1930s. So that tells us, right, that when replacement is costly, we reform, but only when there's a severe crisis. Again, exactly in line with what we said in terms of our framework. The second panel, we can look at thinking about the effects of access by saying, is this a county that becomes unbanked during this time period, right? I said almost every county in the US has a bank in 1920. That is certainly not true in the 1930s. There are many places that become unbanked. This is a pervasive problem, in part, I think, because we made it really costly to open a new bank by protecting incumbents. But what you can see here, again, is that it's only in the 1930s that becoming unbanked pushes you towards having more bank branching. So that's going to be a much stronger and positive effect. So this is again saying you reform when replacement is costly and when it's necessary. So it's this intersection of crisis and credit shortages that's going to cause you to snap out of protecting your incumbent unit banks in this scenario. So to take a step back, I want to talk for a second just about like, why does this matter? So if you think about tracing out what's happening with bank branching from 1910 up until 1994, when there's the final deregulation of bank branching with Regal-Neal, what you can see is that the 1930s are the moment where many states change their regulation. After that, it takes decades for people to want to change their regulation again. So one way to think about what I'm showing you here is that this feedback loop between regulation and crisis severity affects what's going to happen after 1939 because the window snaps shut. The banking crisis is over. We have like some other stuff to worry about in the 1940s. And instead, we're going to lock in this regulation again. Right? And so our theory here can help us understand why sometimes there's so much path dependence, but also why sometimes the regulations change a lot, right? It's really about this idea of incumbents seizing new advantages, and then if there's a crisis, we have a moment of changing that only when we've really increased our barriers. So I'm just about out of time, so I'm going to conclude. A lot of the times we think about the recovery, the crisis and the recovery from the Great Depression, we certainly focus on the importance of lending, banks, and money. And that is broadly true if we think about what's going on across financial crises, where we think the stronger the boom in lending in particular, the worse the bust. Right? So we think about banks as being important because of their leverage or intermediation. We're showing you that there's another way that banks are important, and it's because of their influence on regulation. In particular, we're showing you that their ability to shape regulatory conditions affects not only the severity of the crisis, because it affects your ability to replace what's lost, but also because it affects people's preferences on regulation going forward, right? This is the one moment where we could think about changing our regulation. Things are terrible, but the only way we're going to do that is if we think about this link between dynamics and preferences. And so we think this is important in part because it helps us understand why regulatory structure can be so path dependent, but then in the moment of crisis, there is a window. And we think it's really about this intersection between pre-existing regulation and the severity of the crisis. All right, thank you guys.
characteristics. And things along those lines. So we're actually writing a paper. That doesn't use this. And I'll talk to you.
Are you a timekeeper? Or
Yes, by default, so I'll give you,
I can look. Oh, no, I'm not worried about the minute. I just meant, should I be looking to you?
if you see me with my hand up, it's probably to say like,
I'll be like, hey,
yeah.
all right. What was that?
Please go ahead.
Oh, yeah. Well, thank you to the organizers for having this paper on the schedule here. Monetary policy shocks and financial stability, evidence from the Great Depression. It's joint work with Matt Jerimsky, Chris Mitchner, and Gary Richardson. I'm Angela Vossmeyer. So I have found myself quite the posse of financial historians here. So anyway, in this paper, we are interested in how a monetary tightening episode can influence the stability of the financial system. And obviously motivation here comes from the 2022-2023 monetary tightening and subsequent banking turmoil that we experienced here in the US. And so there's a couple channels in which a tightening episode can influence the economy. Of course, one of those is the usual lending channel. We raise borrowing costs, lending goes down, that sort of thing. The other channel's more directly related to a bank's balance sheet in the sense that the price of bonds and everything changes in the markets. And so the assets or certain sections of the asset side of the balance sheet suddenly reduces, and then we see effects on the banking channel there. Either way, though, we know empirically this is very challenging to answer because of the endogeneity of monetary policy itself, and of course the regulatory regime that we're sitting in, the structure of financial institutions and everything, so forth. But like I said, I found myself quite a posse of financial historians here, so when things unfolded 22, 23, just as an economic historian does, we go, oh, actually, there's a pretty nice instance in history where a monetary tightening episode was sudden and unexpected. And so that's exactly what we do in this paper is we're going to exploit a sudden and unexpected monetary tightening episode and examine how that influenced the balance sheet of banks, subsequent bank closures, and then local economic activity. And that episode is September 21st, 1931, when Britain abandoned the gold standard. So we'll spend some time in the history section. We went through a lot of historical documentation, and when Britain abandoned the gold standard, market participants were incredibly uncertain about what the Federal Reserve was going to do or how they would respond. So there was a bit of anxiety around the time, and then within a couple weeks, the New York Fed raised its discount rate by 100 basis points on October 9th, and then another 100 basis points on October 16th. So probably one of the most rapid and largest tightening episodes in such a short window of time. New York Fed was the first mover. All other Federal Reserve districts followed, and then the market rates also followed. And so what we're going to do in this paper is we have weekly balance sheet information on commercial banks and weekly measures of economic activity, and we're basically going to trace this shock, see how it propagates. We also have detailed information on bank suspensions, and the exciting part about this information is we have all the examiner commentary stating why they believe the bank closed. So that's kind of a newer element in this working paper that we're working into it now, but kind of excited to show you some of that. And we're going to use both local projection and panel data methodological approaches to understand the propagation of the shocks from banks and onward. And so, let me just walk over here. This jump right here, this is the tightening episode that we're talking about. So what we're looking at here is all Federal Reserve districts, their interest rates. And if you look at the red one, that's New York, that's probably the most important. You can see that coming into this tightening episode, interest rates were falling since the start of the Depression. Steadily, couple years of falling interest rates, and then the sudden upward spike in interest rates, and they stayed high. They stayed above that abandonment of the gold standard episode until the end of 32. All right, I knew it was going to come quick. Great questions. So yes, when they abandoned the gold standard on that September date, they were in a recess period, being the policymakers. And so, but people knew that a decision was probably going to come in those first weeks of October. And then separating the effect between the abandonment and the policy, that's definitely something that we're constantly working on in the paper, but because we have the weekly data, we can see that the weeks of the policy decision are what's often triggering the changes as opposed to the September 21st date. But you're right in the sense that the abandonment happened and there was some movement between those weeks in terms of fears that the US was going to devalue the dollar. Yeah. Mhm.
So, in a sense, what was going on with the other two policies? Because some of the, I just read the paper. But the thing is, like, was the discount rate the prominent policy? It'd be good to know what's going on with the other.
Yes. So to answer, yes, it was the prominent tool. But again, when we look at a longer sample, of course, we know there's wild changes in policy. But again, when we try to narrow around these weeks of the abandonment, that's the main thing. And the interesting thing is, I'll show you some quotes, is when market participants were trying to hypothesize what the Fed was going to do, they thought they were going to increase Fed notes in circulation. So use a different policy tool and move in the opposite direction than what they did. Yeah.
I'm worried about real interest rates because we have this big inflation.
Yep.
With the timing of the inflation, what does this thing look like? Because those are really high, really.
Yeah, so we spend a lot of time, so we're going to use a lot of different rates in the paper. Of course, the discount rate is the policy instrument. We spend a lot of time working with the AAA corporate bond yields, basically to try to capture the market price of bonds hitting the bank's balance sheets day to day. So a couple different ways we try to do it, but I'm all ears if there's other.
But Fed didn't really understand what was going on with deflation and turning it into a very high real interest rate. So that's why it seems like you need to be thinking about that.
Yeah, and I don't think this totally fixes your concern, but we have a daily movement in bond prices, and so we can try to match those up with, well, like you're saying, the real costs of borrowing and things.
We'll talk.
Okay. Yeah.
That's not what they're looking at the policy part. Yeah, and what you're talking about is how bad it was because you had issues.
But we're using the nominal to show the policy shock, but in actuality, maybe you should be using the. No, I don't think so, not necessarily. I might want to know what's going on with the deflation at this period over this particular time period, because maybe that's changing what the policy looks like in real terms.
And with regard to what we end up looking at is that the bonds sitting on the balance sheet and the market value of those bonds is changing. But
that's okay. Just keep going.
Eugene?
Yeah, following up remarks, Mark, the general way we thought about it is that the discount is the dominant tool, and then open market operations support that. You have a diagram of the open market purchase, maybe they're anticipatory of this, so we follow it. Kind of how the market might proceed.
I don't, not here, but let me add it. Yeah. Thank you. I have to be. I don't know about you guys. When I take notes, when I present, I'll look back later and it'll just say like banks, depression. And I'm like, what? What did I mean by that? So I'm trying to be better about this. All Okay, and just to show the other data, so we focus a lot on the AAA corporate bond yield. That's the blue line, and so just this guy. This is the spike episode we're looking at. But we use, like I said, a lot of different measures in the paper. The results speak to the same story, depending on which one we use. We focus a lot, of course, on the policy instrument itself, the discount rate, and the AAA corporate bond yield, because a bank's bond portfolio at this time, on average, probably had about 30 to 40% of government bonds, and probably like 30% of investment grade corporate bonds. So these two rates should capture the effect on the part of the balance sheet that we're looking at. We do have in like the robustness junk bonds in there, but I don't think. Okay, I'll take another look at that, but I don't think banks were allowed to hold too many of those. But yes, okay. And so one of the things, obviously we're talking about an interest rate risk story here. And so one of the things that makes this environment, I'll say, exciting and different from the interest rate risk papers that we're studying today is, I'll say three things. So of course, one is that this shock was unexpected, unanticipated. So that's exciting, but also the structure of the banking system at the time. We know from recent papers on interest rate risk that competition for deposits matters for the effect of a monetary tightening episode and a bank's own deposit franchise value. And so in this setting, the competition for deposits is very high. There's a lot of banks. Banks did not have a way to hedge interest rate risk, right? The financial technology wasn't there. And when it came to deposit rates, so the interest that they paid on deposits, it moved pretty much in parallel with the discount rate, and all banks kind of moved together. So there was this heavy competition for deposits. Deposits weren't as sticky as they are today. And then some regions also had deposit rate caps, which kept competition very high. Yep. So
I'm sure you're right.
yeah, I have not in the slides. Well, maybe in the paper we have this picture that shows most of the US was in a region where there was two banks in existence. So the competition for those deposits stayed high, and all the policy reports at the time were complaining about essentially overbanking, and that competition for deposits was a reason why people were pulling their money out of the banks, and also a reason why there were so many bank suspensions and closures. Kind of lining up with some of the stuff Sarah's talking about. Okay. Quick preview of the results. Sorry, I hit a button and now we have an extra thing on the screen. Nope, it's gonna stay there, I guess. Now I've gone too far. So what we see in weeks following the tightening episode is that bank deposits and bond holdings are falling by 10 to 12% respectively. We see an effect on loans, but it's much slower, much more gradual, which aligns with the terms of lending at this time. And bank closures spike up. In the estimates is about 1 to 2 banks per week per state. But if you just look at the raw bank closure data, all bank closures between 1929 and 1932, about 28% of bank closures happen within a couple months of this tightening episode. And so it is much larger actually than the panic that we always talk about being the Caldwell panic and stuff. So we're going to zoom in on these closures and then also get that examiner commentary to see if it's aligning with this interest rate risk story. In terms of economic activity measures, we see meaningful declines in building permits, which is this measure of kind of forward-looking investment, and bank debits, which would be transaction, local spending, that sort of activity. We get into some bank level data sets here, and we kind of just needed some evidence to support the story, right? So it should be the case that if this is an interest rate risk story, then banks that have lots of bonds on their balance sheet, so that high security to asset ratio, which in the low interest rate environment was a very good thing, right? Tons of people here have estimated models on the probability of bank failure, and usually we include that security to asset ratio as like the safe good bank measure. So in our usual low interest rate environment, that measure is negatively associated with the probability of bank closure. Except for this window of monetary tightening, suddenly that variable that was once our good bank measure flips to be one of the key drivers, and it's positively associated with the probability of closure.
One part of the story is that, as the question is starting, as for banks are sort of pulling away from lending and accumulating more safe security, so and therefore exposing themselves to this risk to a greater extent. But I wonder whether that bond ratio itself, for that reason, might be associated with like the underlying risks of the bank's other assets. So you, if you're really concerned that things are bad in your community, then you're really pulling back on lending and or switching into holding a lot of safe government bonds, and therefore making you more exposed to this risk, but in a not so clean sense.
Yes. So we do a couple things, but what you're saying is exactly right. Basically, starting 29, and we read through all the trade magazines, bankers started bulking up on government bonds to act as a liquidity buffer, because basically if there was a deposit drain, they could liquidate those, pay out cash, and it was hopefully survive whatever drain that was happening. So we do see a change between 29 and onwards that banks are moving more towards U.S. Treasury securities. So in this section of the paper, the panel starts from 28 to 32. And so we allow the security ratio to change in some specifications, and then other specifications, we try to keep it fixed at that 28 level to basically pin that decision, not make it so much a function of what was unfolding in front of them. And the results tell the same story about how that ratio can suddenly flip in the tightening episode. But yeah, that certainly was going on in the background, which actually makes it a little sad. They were doing what everyone was saying, and then all of a sudden they're like, haha, never mind. Sarah?
For reasons to change in that period, we shouldn't see that there's as much risk, for example, or is high interest rates.
Yeah, we didn't, but I think it's worth checking out. There was a little movement in 29, but that one was anticipated because the Fed was like circulating these notes about, and anyway, people found out. And so you can almost see the anticipation in that in the data there, where we don't see it here. But no, we didn't go back to 27. Okay, I'm sorry, I'm going to skip the contribution slide just so we can get into the meat of the history, give the crowd what they want. Let me just give a little background in terms of what was going on at home and abroad. So just as Eric said, banks were responding to deteriorating economic conditions, shifting their portfolios towards government bonds and corporate securities. Again, this is something that was documented in all the trade magazines. They were urging bankers to do this to build up those liquidity buffers. And then abroad, in May of 1931, the largest bank in Austria failed. Confidence was shaken in Central European institutions. It spread to Germany, eventually making it over to London banks. And so the Bank of England responded by lowering its policy rate and basically taking a stance, saying that they were going to support their domestic banks and abandon the gold peg on September 21st, 1931. And so at home, just as we discussed first on, there was an immediate response in the sense that gold started to flow out of the US. So within weeks of Britain abandoning gold, the Fed's supply of monetary gold fell from 5 billion to 4.2 billion. And this was happening because investors were repatriating funds from the US to Europe out of fears that the US then might devalue the dollar in terms of gold. And there were some expectations that there would be an economic recovery in Britain due to the monetary expansion that was going to come. So gold started flowing out, and the Fed was put in a very precarious position. They could maintain its low interest rate policy and risk that gold falling below the statutory minimum for the currency backing. So despite having very high reserves, as quickly as it was falling, it did become a concern. Or they could raise interest rates, essentially defend the peg, commit to keeping the value of the dollar fixed in terms of gold. And we went through tons and tons of newspapers and everything between the abandonment on the 21st and the Fed's policy decision. And it was a lot of confusion. So this is just the one I picked for the presentation, but this comes on October 3rd, 1931. And I realized the other two presentations, you know, you get pictures of the newspaper, and so I'm falling short here, I apologize. But the newspaper said that confusion prevailed everywhere. Anticipation of Fed action caused investors anxiety. So to the first point, you know, there was ruffling of the feathers when the abandonment happened. And what was hypothesized that the Fed was going to do was potentially offset the loss of gold by expansion of Federal Reserve notes in circulation, raising concerns that the Fed would embark on a new policy of inflation. So basically the opposite of what the Fed actually did. They were hypothesizing that they were going to expand the money supply, and instead the Fed pushed interest rates. Free gold? Yeah, so we pulled, this is where, so we pulled data from Fed documentation and also The Economist of what was happening to, they had like the different measures of gold in the economy, the backing, and it looked like they were all falling downwards, but we also had a little bit of trouble looking, there was some measurement differences between what The Economist was defining versus some of the other documentations, but yeah. So October 9th, the New York Fed raised its interest rates from 1.5 to 2.5%, and then October 16th, 2.5 to 3.5%. So very rapid, other districts followed, and the rates remained high. The Fed achieved its goal, the Fed achieved its goal of gold stop flowing out of the US. But it came at a cost, and that cost, of course, is interest rate risk. So by December 1931, the Fed had realized that there was some major cost to banking. This was a note from Harrison, who was the governor, New York Fed at the time. He said, more than half of the member banks in this district have depreciation on their bond accounts at present market prices sufficient to cause capital impairment. While the banks have some losses from other causes, their principal difficulty lies in bond depreciation. And so, like I said, deposit rates were moving with discount rates at the time, so there wasn't any way to gain in terms of net interest margin here. In general, it was mark-to-market accounting when examiners came in, though we did see some evidence of some regulatory forbearance here for banks. But nevertheless, if a bank was posting that bond as collateral at the Fed or with their correspondents, that's where the market price of that bond was coming in, and that's where they were getting hit hard on the balance sheet.
A big contractionary change in the midst of a gigantic economic slump.
Yeah.
And so there's not just interest rate risk, right? They're contracting economic activity at a time when, you know, unemployment is rising very, very rapidly in the economy. So that becomes the other thing that you have to sort of try to address. Hopefully it's not locally correlated with the balance sheet composition of banks, but like I feel like it's worth saying that. Like this is a catastrophic decision in many respects.
At a time when everything's very vulnerable. I totally agree. And again, we do our best in so local projections where we try to pin that timing down really well. And then in the bank level estimates, that's where we try to really pin down the individual bank balance sheets to isolate bond issues from all the other issues that can be happening on the bank's balance sheet or to nearby banks that could affect them. But yes, and let me know if you see something along the way where we look a little short or something. Okay, oh, it's a little fuzzy, sorry. So this is a plot. Those blue lines are they're counts of the total number of bank closures in a given week, and that red line is the AAA corporate bond yield. And so you can see as soon as that red line goes up, the bank closure variables spike. And those closures start to happen pretty quick from the policy decision, which was quite surprising to us. And that's where we really wanted to dig into the examiner commentary there. But you can see that the closures are massive. And this first guy right here, this is that Caldwell crisis, which is huge, but this looks a lot larger there. So this is the thing that we're hoping to pin down and explain. The other thing that we kind of needed to almost do a gut check was interest rate risk would be living on all banks' balance sheet. It should not be regional, right? So in terms of total bank closures and suspensions, we should see them across the US. And so within a couple months, this is the plot of all bank closures and suspensions. And you can see that it's geographically nice and diverse. For comparison purposes, just to get another huge panic, this is the Caldwell. So you can see still very large, lots of closures, but much more regionally oriented than the episode that we're talking about. Okay, so into the data. How am I doing? Okay. So we have data from the Federal Reserve's Division of Bank Operations of all bank suspensions, and we know the nature of the suspension and the regulator's conclusions about why each bank was closed. For balance sheet data, we start by using the Federal Reserve's weekly reporting banks. And so the Federal Reserve has a sample of banks from about 100 cities that reported weekly to the Fed, and then they published the statistics at the Federal Reserve district level. And these were supposed to be representative banks, but of course these are large. They came from the Central Reserve, the reserve cities, clearinghouse cities, and many cities beyond that. For local economic activity, we take weekly bank debits, which is available for 264 cities, which comes from Pedemonte's database, and monthly building permits for 229 cities coming from the Cortez and Weidermeyer. And so this is going to help us pick up that local spending and forward-looking investment. Yeah, Sarah? That's a good question. I know for the Federal Reserve weekly reporting banks, so that balance sheet information that we're using, those were pretty big banks that were doing the reporting, so they were unlikely to exit in our sample period. The weekly bank debits, that's a good question. I should follow up with. Right. Yeah, we're not in that period. And then for interest rates, like I said, we're focusing on these two because of their relation to the bond portfolio of the bank. We get daily AAA corporate bond yields from the Commercial and Financial Chronicle. Discount rates, we use a plethora being district-specific ones, which gives us a little cross-sectional variation, but you saw that they all kind of move together, so I'm not going to overemphasize that. And then, of course, we could use the average rate or the New York Fed rate, which would be directly related. And then all of that together results in 4 different panel data sets that we can kind of change aggregation at different ways, but we have, a weekly panel at the Federal Reserve District level, which has the balance sheets, and we can include closures there. We can do a weekly panel at the state level for closures. We just chose state just to give a different kind of cross-sectional variation. And then weekly panel at the city level for bank debits, monthly panel at the city level for building permits. And like I said, we can adapt these in different ways, but this was kind of our starting point with the analysis. And the goal, of course, is to kind of trace out these dynamic responses to the interest rate shock. So we start with the local projection setting, where we can consider 6 different outcome variables. The log of bonds, again, which would be identified at the week Federal Reserve District level. Same thing for deposits and loans. Cumulative closures, which would be just a count of the number of closures either happening at the state or, city, whatever we decide to define closures at. And then debits and the building permits. And so you can see that we include like our cross-sectional fixed effects. So that could be a city fixed effect or a Federal Reserve District, depending on which aggregation. Year fixed effects. The interest rate variable here. So it can have an I subscript when we use the Federal Reserve District specific interest rate. But obviously if we use that AAA corporate bond yield, there'll be no I subscript because it will be the same across all cross-sectional units. And because of that, our inference is based on a wild cluster bootstrap to capture that common time variation that's going to be hitting our outcome variable. And then, of course, we have lags of all sorts of things. And we can flood lags of all the outcomes in the model when the aggregation is set a certain way, and things look pretty good. Same thing when we choose a horizon of 26, lags of 4, but the results really aren't too shaky to changing those parameters. Okay, so onto the results. Sorry if it's a little hard to see, but I do think it's nice to look at all 4 of these pictures together. The top one, so we're looking at impulse responses to a 100 basis point shock to the AAA corporate bond yield. This is to the bonds, deposits, loans, and cumulative bank closures. Yeah, Sarah? Oh, AIC, BIC, yeah.
Given that this is like unanticipated, like I know this is the wrong way to do it, to show us the free period, like to understand like the free period.
Sure, sure. Yeah, we can add those pictures in. And we do like different, like some placebo tests and other things with different lags and leads. And so for bonds, if you take a look at this picture, you can see the response is pretty quick. And it's hitting, its trough here about a couple months out, which looks to be about a 12% drop in bonds here. And deposits respond very similarly and very quickly, where we see the drop also looks right about 12-ish as well here. And so there's a couple different things at play, but we did note that once the Federal Reserve decision happened, some withdrawals started on the bank. And as far as we can tell, most of that came out of fear and confusion. People didn't fully understand what was going to be the outcome of that. And obviously the regulators probably didn't either. And so with some withdrawals happening, banks needed to access liquidity. And so that's probably when they needed to tap their bond portfolio, which meant that they had to sell their existing bonds at the market price, which was now a much lower price, on the market. And so the bond and deposit story seems to line up quite closely with some withdrawals happening. And that also aligns with the Carrera, Luck, Werner paper where they're documenting when the withdrawals are happening. And there does seem to be some in this period around the interest rate decision. Loans, which is down here, is pretty gradual, but you can see it's about a 4% drop in loans over a longer horizon. But that does align with the terms on loans at the time, which could have been, 90 days to 6 months. And interestingly, let me just pop over to this slide here. We can disaggregate loans to those secured by stocks and bonds and those that are not secured. So this would be mostly loans to brokers and things. And that has a pretty immediate response, which you would expect, whereas the other loans is what's having a more lagged response. And then closures down here. This picture was from cumulative closures at the state level. So you can see kind of at that mid-horizon, a couple months out, it's estimating about a total of 15 cumulative closures per state. And this is the one thing that we'll dig into later to make sure that these closures are being documented for reasons related to interest rate risk, as opposed to the many other reasons banks were having trouble, which goes back to Eric's comment about isolating this effect from other things. Yeah.
They call it an internal drain interacting with the external drain. The idea is that people are taking out money from the bank because they want to convert to gold, get the money out of the US. And so that makes this seem like a rather different situation, something, a general case of what happens to banks.
So we disaggregate the deposits into time, demand, and interbank deposits. And so I think the thing that would be closest to trying to pin down or at least isolating would be something like interbank deposits, which we still see if we just look at interbank deposits, it's still a very large effect, meaning banks are even drawing on their own correspondents to pull money out from each other. And then interbank and time deposits have the largest effect with, interbank and demand deposits, with time deposits having a smaller effect. But we do see an effect with time deposits as well, and those ones should have been stickier.
I'm not sure what I would predict about the different. Seems like people, businesses in general, want for
So you're saying,
Like you know, I'm somebody who's well off. I suddenly see Britain go up gold. I think the US might go up gold. I go to my local bank. I say, I want, you know, I want a bunch of dollars. I can convert to gold because I think that gold is $4 value. My bank responds by drawing on its interbank deposits, its lost deposits. You see it's both deposits and bank deposits. I go to my bank, maybe I think bank deposits.
I guess, so does it matter for the interest rate risk story though? Like, cause the banks are still put in a precarious position where they're like, well, I gotta meet this demand, so now I need to access my bond portfolio, which now is in trouble.
Yeah, it's not that I think that's wrong in any way.
Oh.
This would be an objection to this being sort of something that tells us something in general about what would happen to banks.
Right. Well, your thoughts about that didn't happen. Okay, so if there was the demand for gold. Okay, it's coming, gold demand is coming outside. Okay, to run on New York banks. Okay. This is what she's describing, like what goes on.
I like it. Yeah. The bond. Yeah, let me put the. Yeah, I don't have that picture in the paper, but we have it. And yeah, basically what, and especially if we allow these things to interact, or we put basically lags of deposits in the bond specification, and we still see all these things too, but I can make a better picture for sure. Exactly. Well, and I think we agree basically. And so that we're saying if you don't have the franchise value, you'll see big effects. But if that competition isn't as strong as it is, then I agree that it should be the deposit franchise values there, which is protecting the banks from this sort of behavior. Yes, that's it. That's how we take it. Like low deposit franchise value is why this looks so bad. Yeah. Okay. And then we have the two measures for local economic activity. This is bank debits. The jagged nature of this aligns with the payment activity at the time. And you can see it takes a while, but it does get sufficiently negative down here. And it's fairly large. This is about a 40% drop in transaction level activity. And then this is building permits, which again, this is the only one that sits at the monthly level. So not as much time variation, but still very slow, staying quite negative. Again, this is about 50% even right here. So a fairly large drop in building permit activity as well. Of course, the cost of borrowing goes way up. Building permits is going to go down. So in summary on this, we see that interest rate shock kind of quickly impact the securities and deposits, which then propagates to loan supply closure spike. We went through many different robustness checks and things, but let me get to the bank level estimates. So this is where we do kind of like another gut check, right? Individual banks would have had different exposures to this interest rate shock. And where this would have lived on the balance sheet, of course, would have been in those bond and securities holding. So what we should find is that those that had higher bond ratios would have been disproportionately affected by this shock. And so to check that out, we have balance sheets for all commercial banks between 1928 and 1932. And this is where we do our best to like flood in all those additional controls as to why a bank would have issues, other parts of the balance sheet, bank age, county characteristic, what's happening to nearby banks, and so forth. So in some states, this is where we've gotten some conflicting evidence at the time. So some states, yes, for sure, it was mark-to-market accounting, and we can see it on the regulators' reports where they are marking that. We did find some evidence, though, of regulatory forbearance where regulators came in, they realized that bond portfolio looked terrible, and they said maybe they can wait it out, kind of thing. But for sure, when they posted a bond at the Fed or with correspondence, it was the market value. Yeah. But that's why I think it's kind of interesting. So there is definitely some mark-to-market story here. But I also think that where those deposit withdrawals are also happening is forcing banks to sell things at the market value are kind of both at play here.
I think we states having regulators in different contexts having different rules about this. Super nice.
Yes.
They are kind of distinct.
I agree with you. And I think that this has been Chris Mitchner's, he's been struggling with this one because he'll find one thing where we're like, oh, okay, this is the evidence we needed. And then we'll find like a regulatory report that was like, the bonds look, well, let's let them go, you know? So this is definitely a struggle, but we are working on this because I think that would be nice to disentangle those two things happening. So here, our goal is to estimate an individual bank's probability of closure, where of course that security to asset ratio is our key covariate of interest, but we're going to interact that with one of our interest rate measures to basically allow the interest rate to modify the security to asset ratio's effect on the probability of closure. And to spare you from a giant table, we see here that in general, the security to asset ratio is negatively associated with the probability of closure, but the interaction is positive. And when we essentially back out the calculations, it's literally the sign flipping is happening right around the magnitude of the tightening. So the AAA rate went from about 4.4 to 5.4%. At that pre-tightening 4.4%, the security to asset ratio is negatively associated with the probability of closure. At that 5.4, the sign flips and it suddenly becomes positively associated with the probability of closure. A prettier way of, oh, it's fuzzy, of looking at this was just like kind of ignoring the panel structure and almost treating it like a repeated cross-section where you're predicting the probability of closure at each quarter. You can see that when we're looking at the security to asset ratio result, pre-tightening, it's generally negatively associated with the probability of closure. And just in that tightening window, we see that that security to asset ratio flips sign and becomes positively associated with closure. So again, that nice part of the balance sheet that kept the bank safe suddenly became the harmful, dangerous part of the balance sheet. Yeah. Yes, yeah, so we can like pump it full of these different controls and things look very solid. But I've got 3 co-authors that want detailed notes, so I'm stressing about what I'm writing here. And so this is the examiner commentary where we back out what the examiners are saying, the reason for closure. And this is just, we have a couple different pictures here. This is just the one I picked for the presentation, but this is the number of times for bank closures that the examiner notes that the closure is due to bond depreciation. And so exactly as we would expect right around the tightening episode, they're basically saying this bank's failing because of bond depreciation. And so aligns nice with the story. There's more we can do with the data here because there's different like categories at which they can check. So we also have like asset values are falling. So we're kind of working through these data right now to classify these in terms. But this was the clearest in the sense that the examiner wrote down in the report this is due to bond depreciation. Okay, so I'm going to wrap it up. Oh, I'm doing pretty good. So we're looking at banks' responsiveness to an interest rate shock, and with local projections and different methodologies, we see immediate declines in securities and deposits when there's a large and unexpected tightening episode. Bank closures spike, local activity declines, And we see that banks with larger bond portfolios were essentially more harmed by this shock than banks that had smaller portfolios. And getting back to our nice questions here, again, I think this is a nice environment to look at it because markets today are less competitive. We have much higher franchise values. So there is research showing that the monetary policy transmission can be attenuated when you have these nice features. And I think we're kind of complementing this in a way because we're saying when you don't have these features, that competition's really high, you can see large spikes in closures and very large effects to the economy here. Yeah, Sarah.
Because you know exactly how many things are operating like 1929. You can think about showing us that there is whether or not there is any competition for deposits, and whether that's caused there to be pre-existing changes or pre-existing different period assets versus those things evolving later.
So we have some robustness results where we restrict the sample to like bigger cities where competition would be higher. And we still like we see large. Is this
more like x-axis, something about competition, and the y-axis telling us about like the probability of the bond appreciation by exit? Yeah, to show us like and ideally, right? There's not really a lot in terms of it making. So saying that this is like a case where there is no franchise value, I think is it has to be a case where you show us the channel is not open, like that is not correlated.
And restricting the sample to like cities, let's say, where that have many banks versus cities that have a handful of banks. That
right, like so like if you showed it as a 1929 and then you show that there's only this spike in 1931, that's like a very like that the is operating. It sounds like you have a lot of that. It would be another way to show it that really that this isn't really a question about not the timing and the treatment.
right. I'm having trouble visualizing the picture that you're saying, but maybe you can draw. Yes. Yeah. How do you convey that other than just saying it wasn't? How bad was it? I would say it was probably one of the worst mistakes of the Depression. Just in terms of, oh, how much harm to GDP? Oh, okay. Yeah, we can probably do some back out calculations because I think the number that we say in the paper is that it's about 28% of all closures happening around this tightening episode. But if we can do some kind of yep. Yeah. Yeah, which is the opposite of what the Bank of England did, who basically decided I'm going to protect domestic banks and abandon gold. The Fed said we're going to defend the peg, basically. But yeah, I like the idea. We'll get some aggregate numbers to show how bad.
We'll convene, we'll have lunch and then.
That's my clip. Thank you. Okay.
Okay, price scale tech.
So I have a lot of co-authors. Matter of fact, I kept giving the paper and I keep adding co-authors as I go, but no one gets to talk during my question, so probably won't add one today. All right, so this originally started out as a dissertation chapter on just tractors with Todd Sorensen in 2006. We had to revise and resubmit it to JEH, but I became the editor, so I didn't feel like I should publish it. So then it became much, much bigger, and it keeps getting bigger all the time. Okay, so what we're going to look at is the start of the farm programs. Particularly, we're going to focus on the AAA because we can't really fine tune the information we have on the farm loans enough to really get to what's going on with those. Versions of these programs are still in place today. They did have a hiatus during World War II that Paul wants me to remind you about. But then they brought it all back and just kept going. So the AAA payments, they were designed to take land out of production. It's a voluntary choice by the farmer, although there was some coercion. Bankhead Act had a thing where cotton farmers had to do it. They offered a package based on the national benefit schedule and local determination of the amount of land to be taken out. That crop land could be switched to an alternative use as long as it was not another AAA program. A lot of times it got switched to forage, feed, clover, fallow, and hay. In the South, you could not produce any kind of crash crop, but you could feed yourselves or forage and feed. Let's see, so where to go? Okay. They were seeking to raise farm prices by getting the farm prices to be as high as relative to the non-farm prices they'd been in the golden age of 1910 to 1914. They didn't succeed in doing that, but they still tried to do that. They were supposed to pay farmers of all types, but there are plenty of anecdotal evidence that shows that the landowners actually changed the person's tenant status. Paul and I and Briggs Depew have a paper about that. Or they would have the tenant sign over the check, or they just steal it and just go on. Renegotiation could change that, but they had a decline in labor demand and actually drove a lot of tenants and croppers out of the business there. So we built a new channel data set built that using stuff that we had in the Haynes, Fishback, and Rhodey data set for all the county level data on agriculture over this time period. Our panel includes the years 1919, 24, 29, 34, and 39. We also have NOAA information on weather patterns during this time period. We include the Dust Bowl, the 1927 Mississippi flood, just to keep Rick and Suresh happy. We also have other New Deal programs and things along those lines. So the identification, what we try to do is we use county fixed effects to control for long-term fixed things that don't change over time. Year fixed effects are included in there to catch the national shocks in all sorts of different directions. We have state by year fixed effects to capture all sorts of things like changes in farm prices and changes in a lot of things at the state level, because that's the level at which they report these things. We also try working with an instrument based on AAA data, which was used to distribute where to distribute funds. And so I'll show you that in just a sec. We have weather, demographic data, other New Deal correlates. We do placebo tests. We include 1930 values inserted in the 1920s for the same county. And so those don't look very much at all like the actual results that we have. So that's good news. So here's a picture of what the AAA collected to try to decide how much to distribute to the various counties. They collected information on yield and production. Basically, the amount of money that went out to the counties was based on the 5 years of production between 1928 and 1932. So we know specifically this. These numbers are rounded and things like that, but mostly they match up pretty well with the data that we have on output during that period. We're not quite sure about what happens in the middle of the 1930s, whether they stick to the 28 or 32. We've seen conflicting stories about that. To some extent, if we're using the instrument's probably a better instrument for looking at the long-term changes that we look at than for the short-term changes. Okay, so the placebos, in the short run, we use a data set that includes 1919, 1924, 29, 34. The placebos are the opposite sign of, or much smaller than, if they're the same side, than the results we get when we actually run it with OLS in the 1930s in the proper way to run it. So that's pretty convincing that actually there's probably not a selection into the program in that result. The one example that's not is bales per acre of cotton. In the long run data set, we use 19, 19, 24, 29, 39. I'll explain why in just a moment. The placebos here are also much smaller or opposite signs except for the real value of land and buildings. All right, and so what we try to show in the paper is the results of all these various things in pretty much the same table, so you can see for the same dependent variable what happens, and you can see how it changes as you move from different specifications and different ways of trying to deal with the identification issues. Okay, so the short run estimations, here's what we do. We have, in all these estimates, we have county, state by year fixed effects, weather, Dust Bowl, Mississippi River flooding, all those various things, percent illiterate, percent colored, and percent foreign born, school attendance. Those are all from the census, and then we interpolate them between 20 and 30 and 30 and 40. So with the short run estimations, we run OLS with just the AAA and all those variables. Then we add in the other New Deal programs. The reason we don't start with that is the other New Deal programs typically are, we have information that covers the period from 1933 all the way to 1939 in aggregate. And so we can't really sort them out and tighten it down to get down to 1933 or 1934 and 1934. And so in that sense, where we actually try to control for it just to see what's going to happen in that, even though you've got stuff that's happening afterwards. Then we do the IV with the AAA only and the IV with AAA plus other New Deal. And again, the AAA is based on what they actually did in those forms. Here, where'd the form go? Oh, well, maybe I thought we had them. Paul sent them to me. I thought I put them in. What? Oh, I had them up there. Oh, there they are. So these are the forms. So just didn't remember where it was. Okay, and then we also, we were worried to some extent about serial correlation and things like that, so we also include lagged output. A lot of times we also have, for our weather data, we're including like that year, the prior year, 2 years before, and 3 years before. So we're actually controlling for a lot of the weather shocks that are going on during this time frame. Let's see, then, so the first group of IVs, what we do is we use 28 to 32. Then what we do is we use 28 to 29 as our thing. And so what you'll see is the results are pretty similar across all these things. For the long run estimations, now we're actually able to take into account what's going on with the other New Deal programs, particularly the farm loans. We're not going to emphasize that today, but the farm loans actually typically in a lot of cases actually worked in the opposite direction of the AAA. So in a sense, they put the AAA, you're supposed to cut output that way, but they give you a farm loan that causes you to increase output and do things like that. So it adds to the fun, but we don't emphasize that in the paper. So we run the OLS, the IV with lagged cotton output, and we include all these things, the other New Deal programs and all the other stuff. The results, so most of this is going to take some time. So we had cotton acreage and bales. So they cut cotton acreage by 31,000 bales on average across these various counties between 1930 and 1940. And so before that time, they didn't have much, let's see, counts for, and so our AAA results count for 35 to 71% of the reduction in cotton bales in this case, depending on which one you look. Or in cotton acreage. So mean cotton bales harvested, they fell by 8,000 between 29 and 34. The AAA accounts for about 41 to 90% of the fall, depending on which specification you use. They fell 5,000 between 29 and 1939. There's a typo there. AAA positive effect actually worked against this reduction. 2 minutes, so I'm already out of time. Cotton output per acre, increased cotton output per acre as you might expect. Non-cotton acreage harvested went up as you might expect. Machinery went up except for automobiles, everything else worked the other way. And meanwhile, animal power went down mostly. Real value of fertilizer really didn't do much at all. We expected that to be pretty positive, but we didn't. Croppers and tenants, just like we found earlier with Briggs, they fell apart. Farms and farm population, the number of farms actually rose. Actually, well, it had a negative effect in the short run, and actually had a negative or positive, no, had a negative effect in the long run as well. Okay, and then real value of land and buildings went down, and the AAA contributed about most of that. Value of farm product fell, and the AAA accounted for that. So the conclusion, This is the first attempt to take a real quantitative look at the impact of AAA on a wide range of decisions. You know, we have a lot, we did it all with, you know, we assumed that everybody was making decisions on every one of these variables, so we didn't want to control for them in any way, shape, or form. AAA cotton was associated with substantial changes in cotton agriculture. And then the farm loans, if we'd focused on that, actually moved in the opposite direction. So they give you with one hand and take away with the other. And most are in the predicted directions. Thank you.
There we go. Just hide these for you.
Perfect. Thank you so much. My name is Pablo, and I will be talking today about the non-pecuniary cost of infrastructure provision. We know that infrastructure provision spurs economic growth and regional development. So here in the United States, for example, the interstate highway system has been shown to increase both trade and city production, but also overall welfare. But these projects usually come with a cost we rarely consider, that is the displacement of local residents to make room for these projects. And this happens worldwide. So in the year 2011 alone, the World Bank estimates that 20 million individuals were displaced by infrastructure projects. So although this is very prevalent, we know very, very little about what are the costs for those individuals who are displaced by infrastructure projects, but also the residents who live where these projects are built, particularly in the long run. And these costs are actually I think very important to know, as they usually disproportionately affect vulnerable populations, but also they're taken into consideration when providing infrastructure. So just to give you a sense, in 2021, the city of Houston postponed the expansion of Interstate 45 amid concerns of displacement of the Latino community. So I will be studying what are these costs of infrastructure provision by looking at the construction of the interstate highway system in the United States, which is up until today the largest infrastructure project the US has ever built. It started in 1956, and for the bill to pass the Congress, the federal government made 100 maps in cities, which is now known as the Yellow Book maps. And they compromise, and in the law, they say they were going to be paying 90% of the construction costs, where local and state officials were the ones in charge of the exact routing of the highway. Construction was massive, as all were in America. We've seen how many highways there are, but they built more than 4,500 kilometers of highways within American cities that are estimated to have displaced more than 1 million individuals. And who they were displacing was not random, as there are numerous accounts how local officials saw highway construction as a way of removing Black population of their traditional neighborhoods, and also without providing any relocation assistance that was not introduced until 1965. I'm not saying that homeowners did not get a just compensation through eminent domain, but the vast majority of displaced individuals were rented. So let me talk a bit more about the data, how identify displaced individuals in the 1950 census, which will be the main data set I will use, which I geocode for the universe of urban residents, and I will be focusing on counties where metro areas are. So here you will see each green dot corresponds to a household in the 1950 census. Then I overlay the network of highways built between 1956 and 1970 to be as close as possible at the 1950 census. And that's only half of the story. I link people in the 1950 census to administrative mortality records between 1988 to 2005, which these records include longevity and also the last recorded residents that I used to infer mobility across space. So let's start by looking at who was displaced by highway construction. For that, I look at census characteristics as my dependent variable and how they vary with different distance to the highway. I will be binning in 100 meters, having this place as a different category. And I will be controlling for metropolitan area fixed effect and also proximity to the city center, because highways were meant to connect city centers, and also they're sorting into the city center. So what I find is that Black individuals were disproportionately living closer to where highways were built. Within a 2,000 kilometers, an individual was 7 percentage points more likely to be Black. Also, they were receiving lower wages, and they were living in homes that were of lower value. With a caveat, this is coming from the 1940 census. As Leonardo told us, housing characteristics in 1950 census are missing. So what are the long-run effects for these people? In analysis I'm not showing you due to time, I showed that not only displaced people were affected, but also they had an effect, highways had an effect on their communities, pollution, noise, congestion. But this effect is highly local, within 100 meters of the newly constructed highway. So I will be including them in all specifications as a second treatment group, people living within 100 meters of the highway. And I will be using as the control group those living within 100 and 200 meters of any highway, of the highways built, as the spillovers are highly localized, with identification strategy being that condition on a neighborhood, how far you are from the highway is independent of your potential outcomes, which is not testable per se, but the balance tests tend to suggest they are fairly balanced, with the exception of high school completion and also proximity to the city center. All the results survive controlling for these and other characteristics. But if you're not happy with the empirical strategy, I have two other complementary ones. In particular, the first one tackles if you're afraid there are like unobserved spillovers into my control group. I will do matching to individuals living in the same city, but farther away from any highway. And also, if you're afraid that actually condition in the neighborhood, people might, like the distance is not independent of the potential outcomes, I will be using people who were living where the maps were supposed to be, so places that were meant, or there are good places to have highways built through them. But they were not displaced because the maps were actually rerouted somewhere else as the third control group. So let me show you a little bit of the results. I will start by looking at mortality, the death age. So I find that both displaced and adjacent individuals die younger than the control groups, regardless of the empirical strategy used. On average, displaced individuals die 1 month earlier than their peers, and those adjacent to the newly constructed highways die around 20 days earlier than their control group. They also almost leave their communities. They are less likely to be living in the same neighborhood at death as they were in 1950, and relocate to other places within the same city. So they leave their traditional neighborhood, but they move away from their city, they stay in the city, and relocate to worse areas within the city. So I construct a neighborhood quality index based on characteristics in the year 2000, like what I call a death, and I see that displaced individuals consistently end up in neighborhoods that rank worse in the city quality index. One thing that I also wanted to stress is that these effects vary across the racial lines. So if you run the interaction with race, you can see the mortality and also the quality index results are driven mostly because of white individuals are the ones bearing those costs, whereas all groups independently are leaving their communities and relocated within the city. So this is the mortality results, although highways disproportionately affected Black communities were born by white individuals. So why displaced people die younger? So I will start by, and I will not show you, but like it is not because of the destination they move on. These places are roughly similar, and it only becomes worse in the later decades. It's not just after the move that they are worse. It's not because they lost their main asset, as the renters who were uncompensated and did not own their house were the ones that suffered most of the cost. It is not because of the destination employment opportunities or economy in general, as these places have similar unemployment and other measures of market access. But what it seems to be causing this is the disruption of the move per se, as individuals who were affected lost their social networks and moved far away from where they were living. Here are two anecdotal evidence in different cities in St. Petersburg, Florida, and in one from the power broker, how people who were displaced felt that they lost a sense of community, and how they felt left alone, isolated, that no one cared about their thing. So the logical step is can any policy help mitigate this disruption effect, in particular relocation assistance? So I will be exploring in the last part of the paper the staggered adoption of relocation laws across states to see if that has an effect on the results of displacement. So R will denote if you are displaced after relocation assistance was enacted. And the good thing is that displaced people were the ones receiving displacement, not those adjacent. So actually, here in this equation, delta 2 would be like a placebo. And I will be controlling, given that the relocation loss happened later in time, I will be controlling for start of construction fixed effects. So like just to compare within highways started at the same year. What I find is actually that payment did raise longevity, so did compensate individuals enough. So they compensate individuals enough. You can see that gamma 2 is positive and is statistically significant at the 4%, whereas this relocation assistance enactment laws did not play any role for those who were adjacent. I only find effect on mortality, not on mobility, mostly because relocation assistance help individuals move to public housing. And finally, I want to say that this was like a very cost-effective policy, as each dollar spent on relocation assistance programs yield roughly $15 in mortality benefits alone. So thank you so much. And yeah, happy to discuss more about highways in the coffee break.
Thank you. This is the success of the embedded state in England with Leander Heldring, Davis Kedrowski, and James Robinson. We think of today's successful states as Weberian, centering on meritocratic recruitment of a salaried professional workforce. However, Weberianism is expensive. Median OECD government spending today is around 45% of GDP, with over half spent on salaries. And it's also a recent phenomenon. During the early industrial revolution, England spent around 10% of national income while successfully providing public goods. For Prussia, the Platonic Weberian state, this number hovers around 5%. So modern levels of tax per GDP and civil service reforms followed rather than preceded economic growth. How did states then provide extensive local public goods on so little revenue? In this project, we're going to advance a proposal in two parts, characterizing the provision of public goods in the context of historical England. First, we're going to account for the size and composition of the state descriptively. Many individuals worked for the state without getting paid. Across all levels of government in 1835, for example, around 75% of positions were not salaried. Crucially, these were bureaucrats with recognized positions and defined responsibilities, not volunteers in that sense. Then we're going to measure the performance benefits and implementation costs of these unpaid positions. We're going to find that non-monetary incentives substituted for wages, but in addition attracted positively selected individuals, leading in some cases even to outperformance of salaried comparable positions. Thus, capacity can be organized also through a socially embedded state. Fixing ideas about the levels of government in England, below the central state, I want to highlight three tiers of local government: the county, the borough, and the parish. The county, for example, would provide militia services. Famously, during the defense against Napoleon, the vast majority of soldiers was recruited through the militia, where lieutenants, for example, would be one of the key roles. The boroughs provided courts, policing, and infrastructure through magistrates and constables, and parishes provided poor relief, for example, through overseers of the poor. Consulting a wide variety of sources, we then measure the size and composition of the state in England. In 1835, around 20,000 people, all paid, were part of the central state. The county and borough made up around 53,000 people, with a vast majority of them not paid, and the parish, making up the bulk of this accounting, was overwhelmingly not paid. Thus, the state was overwhelmingly local and local government overwhelmingly unsatisfied. Now, in our second part of this paper, we're going to focus and zoom in on boroughs, which provide nice variation across paid and unpaid status, and where we can compare these comparable offices. The crucial aspect to note, of course, is that unpaid offices, by definition almost, left a limited documentary republic, having some historians call this the unacknowledged republic. We thus rely on a unique source, the Municipal Corporations Report of 1835, which provides a comprehensive study of 258 such boroughs commissioned by Parliament and executed by independent lawyers, exactly to understand and document how England was governed. We're going to extract information on local state positions, identify their paid status as our key right-hand side variable, and then link these positions to their assignment on 7 core tasks, measure borough performance on these public goods ranging from government to police. And this is going to be our core left-hand side variable. We additionally collect a lot of information on the details about the pay and performance, as well as corruption, individual officers, boroughs, and so on. Here's East Lou, for example. East Lou has a recorder, a town clerk, surgeons at mace, constables, keymasters that all do different things in the borough and that are or are not paid. And then the more fun part of coding up this in a manual way, which we split between us, is the performance parts, where here East Lou's jail is ill-ventilated and unfit for the reception of prisoners, and the constables are remiss in performance, with the town being frequently disorderly. So we code this up into performance measures. Just as a first smell test, let's then compare an officer's average task performance and correlate this with whether or not they're unpaid. And then we can net out borough fixed effects to just get in a first pass at whether or not it might be easier or harder to implement some tasks. And when we compare raw means and or look at this in a scatter plot with borough fixed effects, what we find is that unpaid offices generally outperform, plotting average performance on the y-axis here, their paid counterparts. And this is by a pretty sizable margin. Now, of course, there are two looming questions when just descriptively comparing these officers. First, we're measuring a team outcome here. We just have a couple of people, for example, working on law enforcement. So how do we identify individual contributions? We derive and estimate a model of team production, which you then proceed to estimate, as well as showing robustness to our model assumptions to really make sure that we're identifying the individual contributions here. And then secondly, of course, there's identification. Are easier positions just more likely to be unpaid, or are boroughs in which it is generally easy to perform certain tasks more likely to have a lot of unpaid officers? And for this, we're first going to be very carefully constructing control groups through fixed effects, controls, matching, and looking out for outliers. And then we're going to isolate a plausibly exogenous component of unpaid status and task assignment from the historical contextual knowledge about the financial and constitutional constraints that these boroughs faced. Across all of this, and in the interest of the egg time, you're going to have to take my word for this, we find that our results are robust and these unpaid offices outperform their counterparts. How can that be the case? Well, we're going to look at two channels here. First, incentives. Prestige, autonomy, and stepping stone career concerns might be attached to these offices to compensate for wages. And then the specific social structure of England at the time might lead to these unpaid positions attracting positively selected individuals. Embedding the state in this way has obvious costs. First, there might be a limited ability to motivate effort on onerous or low prestige tasks that you can just not get anyone to pay to do because it's hard to attach prestige to it. And then there might be greater scope for patronage and corruption when oversight is weak, when you compensate someone with autonomy. As a side note, we're going to not find that corruption, while it does co-occur with these tasks, is not a precondition for performance. Here is a visual example of attaching prestige to a job. This is the Lord Mayor of London, to this day, I think paid a bit more than it used to be, but the main compensation is being ferried around in a golden cart as part of the parade on your inauguration. Econometrically, we're going to derive proxies for incentives and selection measures and correlate those with whether or not you're an unpaid position. We're going to find that our proxies for prestige, career concerns, flexibility, and autonomy are going to be positively correlated with unpaid status. And then the same for selection. The gentry and clergy, political and economic elites are more likely to take up these jobs. Very happy to dive into the exact definitions and the robustness checks we have for each of these measures. Taking stock, we can then characterize the system of incentives and selection. We're just collapsing both into a score. And what we find is that these co-move. So there's a Weberian corner where you get low incentive, low selection, and then high incentive, high selection in the upper corner. So to conclude, for government, embedded local incentives were widespread and effective. Boroughs relied heavily on those, providing core public goods, and often doing so better than their paid counterparts. This worked because it paid in status, autonomy, and career opportunities within limits where low prestige or onerous tasks were harder to motivate. Broader implications for state capacity, though, is that often we proxy state capacity with tax revenue and with the size of the salaried bureaucracy. By that measure, many states, historically and today, look small. But states can also draw on non-market institutions with distributional and dynamic consequences. Ways of organizing state capacity thus reflect the constraints, public good demands, and social structure of the context. And social embedding extends the reach of the state, but cedes control. And this may explain both differences in performance between resource-constrained states, as well as this fact that civil service reform follows rather than preceding economic growth after enough fiscal revenue is amassed to get around these constraints and take back some control through the center. Thank you very much.
Thank you very much. I appreciate everyone coming to this talk and in advance coming to the next talk as well. I would like to chat with you a bit about some work I'm doing with my colleagues Eric and Sharon and Chizha Wang, who's a brilliant grad student who's sitting right there. And if you have any questions about why meat prices are currently high and will continue to rise, she is the person to answer that question. So please take advantage of the opportunity. So in this paper, what we're interested in is understanding the development of the American state, and in particular, the tariff collection of the American state. So for most of the first 60, 70 years, tariff collection was like 90% of all government revenue. So it's super important. And so policymakers think really hard about how to do it. And if you take a trade class, the thing that you would learn when setting an optimal tariff is something about like optimal, like inverse elasticities, things like this. It turns out that's not at all what they cared about. What they cared about was fighting evasion. And so what do I mean by this? So the typical tariff that you might think of is an ad valorem tariff, so as a percent of value. But like, of course, these are like foreign invoices. It's coming from abroad. It's like there's all sorts of complications. And so it might be easy for importers potentially to cheat on the value and to say that the true unit value is lower than what the actual unit value is. And then you get less tariff revenue than you might otherwise want in like a world where you're omniscient. Policymakers understand this, and they also understand that disagreeing about values is difficult. It's hard to sort of figure out how to resolve disputes when it comes to something that doesn't have a ground truth like a value does. But you could also charge tariffs based on quantities if you want. That's called a specific tariff. Counting is like, we can all agree if there's a dozen of something or 3 dozen of something potentially. And so you could do that, and that evades the misvaluation concern. But the problem with specific prices with specific tariffs is they distort relative prices. So why is that? Suppose we just had one specific tariff for everything coming into America. We could charge it based on like weight, but then what that would mean is either we're charging like a ludicrously high tariff per brick or a ludicrously low tariff per diamond. And so it's going to be, actually, either bricks are going to be really expensive or diamonds are going to be too cheap. And so they understand this as well. The solution to this problem also, which is instead of just having one specific tariff, you can have many tariffs. You could kind of try to partition this set of objects coming into the country into narrowly defined categories, and then you don't have to worry about the second bullet point. But then you open yourself up to fraud again, this time misclassification, where it might be hard and expensive to define very precisely what something is in order to figure out what the appropriate tariff rate is. Okay? And so for this paper, what we're going to do is we're going to try to think about how the state figures out how to manage these countervailing forces. Much like Sarah's talk earlier, it's basically going to be like a bunch of economics telling you that what they say they care about is in fact the thing that they care about. So let me just tell you what they care about. So this is from the State of the Union. There turns out to be 2 State of the Unions that discuss specific versus ad valorem tariffs. So the first one is from Hayes, who says, look, we want revenues that should be simple in their provisions and easily understood, but we want specific duties as far as practicable. So that's going to keep that in mind. And not ad valorem, because if you have ad valorem, you need experienced men to ascertain values, because it's otherwise costly to do so. So that's pushing towards specific tariffs. That's like one camp. The Polk administration, the Secretary of Treasury for the Polk administration, says no, it's fine that maybe there is evasion, but we really dislike the fact that specific are unequal and calls them oppressive, because they distort relative prices, and in particular, people who want to buy cheaper goods, in particular in the South, the effective tariffs that they pay are going to be higher. Okay, and so our paper is basically going to be this third quote from Manning, who's Secretary of Treasury a little bit after our sample, who says, look, you could write down a model, like obviously not write down a model, but you could write down a model, 1 in 100 years could write down a model about why ad valorem tariffs are preferred to specific duties, because they don't distort prices, but in practice, you're gonna need to use specific duties in order to evade these evasion costs. And so we're going to write down a model, which is basically just this in like CES. Okay, so that's going to be the plan for today. In particular, we're going to focus on studying American tariff policy from 1789 to 1846. I'll tell you why 1846 is when we stop. And broadly, we're interested in how like the capacity to collect tariffs, and in particular to avoid potentially misclassification or misvaluation, or faced with misclassification and misvaluation, affects the design of the tariff code. And so we'll do it in 3 steps. First, we put together a bunch of data trying to understand the evolution of the customs and the tariff code. And in particular, what I'll show you is there's a lot of investment in the customs house, and the tariff code gets much richer and much more interesting over time. Motivated by, in particular, the first fact, we're going to try to write down a model of like, okay, suppose you cared about misvaluation and misclassification. What implications would that have for the tariff code? And then I'll show you that the model's predictions like actually hold up in the data, and so the thing they say they care about, they act as if they do care about it. And furthermore, the model's going to have some predictions for like the evolution of the tariff code and trying to understand if that evolution is being driven by different kinds of improvements in state capacity. And I'll be clear about what that means over the course of the talk. All right, so that's it for the plan. I'm going to skip the literature review, except to say probably you may have never thought in your life that you care about specific versus ad valorem tariffs, and I'll try to convince you very hard that it's really interesting. But I will tell you it's one of the original questions in all of economics. So Cournot worked on it. You know, we're caring about evasion. Obviously, Cournot cared about market structure, but this is like a very classic question going back, you know, hundreds of years. Okay, so the data that we use, yeah.
This is politics, right? This is lobbying. So how do you put that together? Because people were, you know, we're really pushing for protection for their specific commodities.
Yeah, so I think there's kind of two answers to that question. I'll show you a quote in a little bit that's like literally a quote designed for protectionism. So in particular, what specific tariffs do is because specific tariffs make it so that cheap goods are particularly protected. If you make cheap goods, but you're worried that you can't politically pass something that's explicitly seems like it's high protectionist, then maybe you have a specific tariff on like kind of a broad set of goods that seems reasonable, but in fact is like protecting you. So there's a specific story in which basically Lowell tricks Calhoun into accepting specific tariffs on cotton cloths, because like Lowell understands that this is going to protect cotton cloths, and Calhoun's like, this doesn't seem like that bad. So for sure there's lobbying involved. I'm not going to talk about lobbying at all in this paper. In the paper, we have some sense of which kinds of industries are more affected by this. And all of the results I'm going to show you, if you don't consider those industries, if you, for instance, if you only look at agriculture, all of the patterns I'm going to show you are also true in those sectors. So for sure, there's all sorts of reasons why you might have high versus low tariffs in some particular sectors versus others. But we're interested really in this like capacity-based margin, and I'll show you how that has implications. Okay, so what the tariff code looks like is the tariff code is basically like a bunch of words. We haven't invented a classification system yet. That doesn't come for another 100 years. And so it's just like these kinds of carpets, those kinds of carpets. Sometimes the tariff bills are written in a way that makes sense. Sometimes they're written alphabetically. Like they haven't thought about how to do it yet. And so what we did is we read all the tariff bills and all of the years in our sample, and we harmonized them. And we sort of, in order to create like a consistent list of what's getting what tariff in any particular year. And there's going to be kind of three terms that are going to be important to keep in mind. I'll walk you through some examples in a second. So the first word that I'm going to use is the word label. You should think of the word label as like the thing which is actually written down in the tariff bill itself. Underlying labels is like the good that's actually coming into the United States. You could think of that as like an HS4 and HS6, like a specific product. And so we're going to try to match the labels, what's actually written to the goods. And then within each goods, there's like potentially underlying varieties, like things that are too narrowly defined in order to be thought of as a good, like an HS10 or HS12 or something. So what does that mean in the context of carpets? So the first bill ever passed after the Constitution is an oath in office. The second bill is a tariff bill. Like it's super important to the history of the United States. And that bill has like almost all goods are covered. Almost all goods are covered by an extremely general label, which is all other goods, which are getting a 5% ad valorem tariffs. And so if you try to import a carpet in like, January 1790, you're going to pay a 5% ad valorem tariff. Carpets pretty quickly get split off into their own category, and then in 1824 they get split off into many, many different categories, which is the picture I showed you here of all these specific different kinds of categories, and they continue to get disaggregated over time. Already to give you a sense of how our model is going to kind of work, when they create these really detailed types of carpets, the only one that stays with an ad valorem tariff is like other carpets. All of the ones that are particularly enumerated get a specific tariff. Okay. 1824 turns out to not be a coincidence. There's lots of disaggregation that happens in that year. For reasons that'll become clear later. This turns out to be in the aftermath of in 1818, there was a customs scandal. If you're importing something to the US, like sometimes you already have a buyer and sometimes you don't. If you're looking for a buyer, you can basically cover your tariffs with an IOU. And some customs houses never collected on those IOUs, and that was a huge scandal, as you can imagine. And so in the aftermath of that scandal, they hired a bunch of well-qualified officials, was the official bill. And that sort of in the aftermath of that, you also see complexity in the tariff code. Okay, so I've told you that there's carpet labels and there's carpet goods, but even within these pretty narrowly defined things, there's still heterogeneity in varieties. You can import a treble ingrain carpet, but like if you go to a carpet store, there's some that are more expensive per square yard and some that are cheaper per square yard based on the quality and the density and whatever else. And so that's also going to be an important force for thinking about tariff policy, is within however the good gets defined, how much price variation is there in all of the different varieties that make up that good. So those are going to be kind of the three objects that we need to keep in mind. Okay, so most of what I'm going to talk about today is going to be from the perspective of like the tariff bills, like what tariffs do we choose to set. We know a little bit about actual imports. They're very bad at keeping track of that until basically the 1860s, which is after our sample. There's very little disaggregation before the 1820s. They're okay in the 1840s. In particular, the thing that they're very bad at doing is keeping track of what actually gets imported into the US in any way that's consistent. So it's like we've basically been able to make a harmonized panel for anything other than the smallest number of goods, which I will show you. But we can have like repeated cross sections. So like for the goods they choose to report imports of in like 1843, I can tell you what some facts about them. Yeah. So we know how people vote. There's like a few like weird scandals where everyone thinks everyone else is going to vote no and they all vote yes on a tariff that everyone hates. So like there's all sorts of weird stuff happening with log rolling and such. It's remains a mystery to me actually. Like they end up with like incredibly ludicrously detailed tariffs. Like there's 3 different tariffs for olive oil in casks, not for salad, olive oil in casks, not for salad, and then olive oil for salad. And we've yet to figure out who has thoughts on 3 different kinds of salad olive oils and why they want different tariffs. So I can't tell you much about the process about like for any particular line, like what was the person that named it. There is broad lobbying, so I can tell you that like specifically when it came to cotton cloths, it was Lowell that pushed for specific tariffs that of a particular rate. Okay, so with all that background in mind, let me show you what the customs look like. So in particular, even though we were just told not to in the last talk, I'm going to show you what happens to employment and revenues. So on the solid line, that's the collection cost. So how much is spent by the customs house. The government is very aware of the fact that there's gross receipts and net receipts. And so if you spend money to collect stuff, that's not actually revenue you get to spend elsewhere in the government. So they keep very careful track of how expensive the customs house is. You can see that basically steadily rising over the course of our sample period. And the dashed line is the gross receipts, like actual imports coming into the country. There's all sorts of interesting stuff happening here, which I'm sure not many of you know about, but is kind of orthogonal to what we're interested in. One thing you can see is there's just like kind of general growth. The main force that we're interested in is there's just like lots of investment in customs, whether, you know, I'm going to try to argue that state capacity is increasing. The data is consistent with state capacity increasing, whether that's because productivity is increasing or whether it's because like returns to scale, just when you have more people. I'm not going to take a particular stand on, but I will say that there is, as the collection costs increase, there is an interesting organizational pattern within the customs house. So it's not just that they hire more workers, but they create hierarchies. And so at first, you know, at the dawn of the Republic, there's basically like 2 or 3 people working in any customs house, and they have like incredibly broad responsibilities. And as they expand the customs house, and particularly as they choose to expand in the 1820s, you start seeing people that get jobs that are like all they do is inspect, all they do is gauge, all they do is measure. For those of you who've read The Scarlet Letter, so Nathaniel Hawthorne, so his job was particularly like weighing coal. And that's like all he did, and he wrote very eloquently about how much he hated it. But you know, it's a very talented person with a very particularly narrow remit happening kind of in this period. Yeah.
It's a period of rapid, extensive growth. I mean, the economy is growing about 4% a year. Deflating this relative to the overall growth of the economy might, I don't know whether it would change your impression of this. I mean, we're spending more, but is it more relative to the volume of economic activity in these years?
Yeah, so
I mean, you know, is this just speculation because we're getting bigger, or is this?
I'm sorry, I think those are all interesting questions. They're a little orthogonal to the question that I'm interested in, which is just like, we are getting bigger. What do we do with this? Again, like whether it's just imports in dollars allows you to build capacity or imports as a share. There's not a lot of inflation. So like, to the best of my understanding, like you could deflate this by PPI, like that wouldn't matter much. But yeah, as a share of GDP, it's obviously not increasing as much. But GDP is increasing.
Terms going up.
Yeah, no, exactly. But all I care about is that there's more investment. That's the key. But mostly I'm gonna talk about tariffs. Okay, so what do the tariffs look like? So this is the words that are being used in the tariff bills. So this is a cumulative sample, so it's mechanically increasing over time. So this is just like every time we see something that we hadn't seen before, we include it. We try to deduplicate because obviously they use different words to mean the same thing. And you can see just like over time, they keep adding new and new things to show up in the tariff bills for a variety of reasons. But one thing that's kind of interesting is you can look at the number of tariff rates that are enacted. So obviously this isn't filled in because that'd look ugly. Every bar is a tariff bill. Some of them are smaller, some of them are bigger. And you can see that the number of tariff rates, like distinct tariff rates, is broadly increasing over the course of our sample. Now, obviously, you look at this and you're like, Martin's trying to trick me because it's not increasing over the whole sample. So what's happening here? Well, South Carolina doesn't want to enforce the tariff code, and there's a panic. And in the aftermath of that crisis, they basically dramatically simplify the tariff bills. And so, consistent with that dramatic simplification, they lower the number of rates and then kind of increase it again in the 1840s. Okay, so like I'm mostly going to be thinking about like the literal capacity to enforce tariffs and like thinking about how that matters. But of course, in the background, there's lobbying, there's political constraints, there's all sorts of other stuff that's kind of going to be orthogonal to the story I'm going to try to convince you of today. But it's happening and is interesting, and I'm happy to chat about it. Yeah.
Is that true with firms? To what degree do you see sophistication?
So the firms try very hard to cheat tariffs. I have some, but
Not about cheating, which is about understanding costs. Gets into making sure you're basically compliant.
yeah, I think that's part of the cost as well. And then you see this in the modern era as well, as like in many contexts, like importers like literally don't know what the relevant tariff is, and customs officials in some countries like won't tell them, basically in order to extract bribes. So I think on both sides the classification costs are real, and sort of the model I'm going to write down is going to be super abstract, but you could think of it as like part of the cost that the government cares about when thinking about this classification is like everyone else in the economy. But I'm going to have less to say about growth than everyone else in the economy and more to say about the government's investment in itself. But that's a totally reasonable thing. Okay, so I fucked up. So not too badly, fortunately. So with those two facts in mind, like there's we're getting more and more complicated tariff codes over time. Like we're investing in the customs house. Like let's try to spend a little bit of time like thinking formally about what the implications that might have. Okay, so I'm going to write down the simplest model that I possibly can. I'm going to walk through it so fast that you're barely going to notice. There's lots of reasons why I have complicated tariffs, and none of them are going to show up in my model except for enforcement costs. So like revenues, it targets exogenous. There's no like terms of trade that you might care about. The tradable sector is small, so no feedback on weight. Like think of a world if it's like anything interesting that's happening to trade is not here, okay? So because the only thing that I care about is going to be enforcement costs. Demand's going to be CES. Again, this is just like to make life really easy. And so consumers are going to have sort of constant substitutability across sectors. And then varieties are going to have like constant marginal cost, are going to be perfectly elastically supplied. Like everything is going to be as boring as possible. And what the planner is going to do is the planner wants to minimize the price index. So they want to minimize the distortion to these prices. But in order to hit their revenue target, that's kind of the goal of the planner. Okay, and so what I'm going to do is I'm first going to sort of tell you what the importers and customs officials are going to do when faced with tariffs and reported values, starting with a single tariff case. So suppose we have one uniform tariff, and in the model I wrote down in the absence of enforcement costs, that's what you'd get, a uniform ad valorem tariff, which is the standard finding. And then I'll show you like in a setting where there's multiple tariffs, you can charge different tariffs on different goods, what kinds of goods are going to be getting specific versus ad valorem versus high versus low tariffs. Yeah, Paul. Yeah. There definitely are complaints about re-export fraud. Um, that would be a force-inducing simplification, yeah. I'll be very precise about how we think about in simplification in this about splitting goods and classification costs in this setting. But yeah, if you could think of it as either trying to avoid importers lying or re-exporters lying. I haven't thought about it, but I don't think it would make a particular difference to our model. Just like you want to prevent that. Those are different.
So is the single tariff case a single tariff on everything, or is there something?
Yeah, single uniform tariff. So I'm just
no zeros to that. Everything gets covered.
Everything gets covered. So I'm gonna just like it turns out when you have multiple categories, like you start shifting expenditure across categories as a function of what the ad valorem equivalent, as a function of the tariff rates, and that makes the math like ugly. And so I'm going to start with the math that's not ugly, and then I'm actually going to skip the ugly math altogether and just show you predictions. So that's how it's going. Okay, so there's two dimensions of state capacity that we think of are important as a function of what the sort of policymakers at the time were discussing. So the first notion of state capacity that's already kind of been previewed is there's this like classification cost, CS. So what is a classification cost? You want to have some categorization with a particular kind of complexity, which like think of it as like the number of distinct rates, and there's going to be some multiplicative cost of that as in order to be able to actually enforce that. Okay, so you have to train customs officials in order to be able to distinguish between like different kinds of iron or different kinds of cloth or different kinds of carpet or what have you. So that's a kind of a fixed cost you pay in order to define the tariff code at a particular level of detail. And there's also verification costs that you might have to pay. So when something comes into the country, if you're charging an ad valorem tariff, the person reports a value, you may want to choose to verify it and see what the real value is. I'm using the word verification really precisely. There's lots of examples here where like it's not like the customs official could know that the importer is lying. So there's all sorts of like prices that no one believes that show up at port. But the problem is the customs official can't like unilaterally charge a higher tariff. There's like a legal process. Unfortunately, we have the rule of law, at least for now. And so we have to get a judge involved. You have to get a jury involved. You have to get well-qualified experts involved. And so if the accused party, especially the French, can bring witnesses that are willing to lie about what the value is, now all of a sudden it becomes really expensive to verify what the good is so that the judge agrees that the person has to pay a higher tariff. No, they do in England, but they don't here. That would work. Okay, and the Danish do it too. Okay. Yeah, fine. So there's also a naval officer. There's revenue cutters, which at first was a name we found very confusing, but then we figured out it meant boats. And so that's from my perspective, that's a little orthogonal to the story we're telling, because like if you want to evade tariff, that's a function of like the burden itself, like a high versus low tariff, like whether it's specific or not, like you don't really care if you don't want to pay the tariff in the first place. So yeah, I agree with you that you want a Coast Guard, but that we're not going to talk about that. That's fair. Okay, so there's order of magnitude. There's two kinds of tariffs that exist in the world. There's ad valorem tariffs, which are charged a percent of value, and there's specific tariffs. That's like if you import 1 unit of a good, you pay T, and where V is going to be the notion of the unit value that they are getting. Okay. So what are importers going to do? Well, importers don't like paying tariffs, so they're going to minimize their expected tariff payments. So what are they going to do? They're going to get their things, they're going to put it on a boat, they're going to ship it to America. When it gets to America, they're going to report some value, V prime. So there's a true value V. They're going to report some value V prime, which is like an equilibrium thing, and understanding what's going to happen on the next slide. The importers are all risk neutral, as I mentioned, so they're just trying to maximize sort of expected profits, and they're going to try to, that's the V prime they're going to choose. Okay, so you're trying to think to yourself like, what is the report that I can give that's going to maximize my revenue? Understanding that what customs officials do is they hear this report V prime, and then as a function of that, potentially as a function of that V prime, they can choose an inspection rate. So they can say, like, if whatever you say, I'm going to inspect with some increasing probability or certainty or whatever. We don't have to assume anything about that. And then the rule at the time turns out to more or less be a statutory fine on the evaded amount if caught. So if you like evade $100 worth of tariffs, then you have to pay a fine kappa on those $100 worth of tariffs. Now, a thing that's been known to economists for a long time, but turned out to be known by policymakers for even longer, is if you set kappa to infinity, you're good. If you have an infinite punishment for a crime, people won't choose to do this. Unfortunately, there was a political constraint. So in 1828, they basically tried to have like a really high punishment for any tariff fraud. And what happens is juries basically nullified it. Juries refused to enforce what they thought of as unfair punishments. And so they had to go back to normal fines. So you could think of like kappa as exogenous from our model, but you could think of it as like some exogenous social or political constraint that makes it so you can't charge ludicrously high fines, which means that there's going to be an equilibrium evasion. And how much evasion there's going to be? Well, it turns out that there's a unique outcome to this model, which is an outcome which is equivalent to importers shading by a fixed amount. What is the amount they're going to shade by? Well, it kind of makes sense. Like you want to lower exactly so that the expected benefit of the customs official of choosing to pay the verification costs, but then also getting the fine, cancels out. So you want, okay, so you don't want to do less than that because then you could get more revenue. You don't want to do more than that because then the customs officials could inspect for sure. So you want to evade essentially by a constant amount as a function of the tariff. That's what the importer is going to do. And then in equilibrium, what is there's going to be a constant inspection rate. That's what the model predicts. That's also what the law is. So the law is to open, depending on the year, essentially open 1 out of every 10 packages. So this is like consistent with the equilibrium, incredibly. And so yeah, so that's the unique outcome of this model. You can find other equilibria if you want, but in payoffs they're all the same. So this is going to be the one that we're going to focus on. Yeah. No, because everyone lies, but not everyone gets inspected. So the like, yes, in this equilibrium, everybody is lying. So like these people aren't different between inspecting or not, and these people are.
I guess the interpretation was that the case back then that when they inspected, there was almost always a line.
So in practice, no, because like if you lied by amount that was viewed as not that large, but in percents, they might let you get away with it. But yeah, the quotes that we have are basically like everybody's lying, especially the foreigners. It's like there's like you can open up any treasury report you want and there'll be a line like that sounds like this, but it's not obviously not literally all. Okay.
With being guilty, kind of like a 0-1, where it's like, if you said that like your nice carpets were actually cheap carpets, like, versus like, you said they were carpets, but you opened it up and there were like some necks. Like, was there some notion of like, I mean, it seems like this notion of like the judgment being a little flexible, it also leads people a little bit to maybe like credibly be within category as opposed to like more outright.
Yeah, so I 100% agree. In practice, both historically and today, like there is misclassification in equilibrium where importers say that they're bringing one thing when actually they're bringing another thing. We're not going to allow for that in the model, just to make life a little bit easier. And so the only thing in the model that they're allowed to do is shade down their value. They're not allowed to change categories. And the way we think about it is basically like there's some cost of setting up the classification scheme. If you want to like have it be that cost gets imperfect enforcement, you could do it, but it's gonna like it's not going to change any of the outcomes, I don't think. But like for reasons I can explain offline, the equilibrium no longer is as pretty as this.
Because you kind of motivated with like salad dressing, olive oil, like regular olive.
Yeah. So you have to hire someone that knows if something's a salad olive oil or not a salad olive oil. You need to. No, in your model, in our model, you have to pay. So you have to hire an olive oil expert in order to be able to classify and have different tariffs and different kinds of olive oil. So that's expensive for you to do, and so you may or may not choose to do it. But then you have the expert, and the expert can look at it, smell it, taste it, I don't know, and then know what kind of olive oil it is. That's the model.
Quick question: can importers choose to bribe the customs official? Is that?
So this is the craziest thing. So the treasury reports at the time talk all the time about how importers are liars and how customs officials are lazy. So like we're thinking about a world in which like there's like the government setting things and there's some lying, but like whether it's the importer lying or the customs official lying, but like never in the customs report do they talk about bribes. It's just like not a thing they seem to be concerned about. Like people steal from the customs house all the time. That's also very common, but like they steal from America. They don't take bribes. For the model, I don't actually care in the sense of like what matters in equilibrium, the payments that show up in DC. And so it's the importer or the colluding with the actual ground customs agent or not. The model doesn't particularly care, but for whatever reason, they don't seem to be worried about bribery in a way that like today, this is the main thing that people are worried about. We did not expect that. I'm sorry, he had his hand raised. We've set rules. Not that I know of. I've never seen that. Yeah, if you take I mean, fair enough. I think probably in equilibrium, you don't want to be sending the salad olive oil to like, Mobile, Alabama, and then having to ship it all the way back to New York. But yeah, in principle, yes. Okay, great. So the revenue
Makes sense that like the US government would not be talking about like our employees or like taking bribes from them, though maybe they would talk about it. It seems like if anyone was to talk about it, it'd be more like the importers or like people from England and France would be like, make sure you take some nice stuff so that you can like bribe the people and get there. The fact that like, if they're never talking about it, that makes me think it must be fun.
I've never seen descriptions of bribery in this context, to my surprise, I think is how I'd put it. Okay. So so there's an equilibrium of this game. What's the revenue going to look like? It turns out the revenue of this that you're going to get from charging an ad valorem tariff is going to have two components. The first component is the regular thing you'd get in a model without any evasion costs whatsoever. And the second one is basically like an additive shift, a subtractive shift down, which is basically like you get the revenue minus a component, which is coming from the evasion costs and the fact that you have to pay some enforcement costs. So So both in equilibrium, actually, the thing that matters is the fact you have to pay these enforcement costs, and that lowers the net revenue that the government gets relative to the gross revenue they get from the actual tariff payments plus the fines for the people that get inspected. Okay. And so let me show you what that looks like visually, because I think it's pretty easy to see. So this is, so the x-axis here is the revenue that you might want to raise. The y-axis is the price index. That's, you know, the more revenue you want to raise, the higher the price index for consumers. So the black line is in the world where there's no evasion costs. The red line is just that shifted over. Why is it that shifted over? Suppose you want to raise just the tiniest bit of revenue. Without evasion costs, you could just set an ad valorem tariff of 0.000 tiny bit. That's fine, and then you'll get that much revenue. But with enforcement costs, you can't do that, because if you set a tiny ad valorem tariff, the people are going to lie. You have to pay enforcement costs, then at net you're going to get negative money because the revenue coming in is less than the amount you have to pay to actually get the revenue coming in. And so in order to raise a negligible amount of money, you actually have to charge a discretely positive tariff, which has a discretely positive jump in the aggregate price index, but then it grows at the same rate that the normal tariff would grow at. Okay? So that's the equilibrium with ad valorem tariffs. It's basically just a shift in what's going on. What happens with specific tariffs? So with specific tariffs, for really, really small specific tariffs, it turns out they don't actually really distort prices, because like if you charge a tiny unit-based tariff, proportionally it's tiny to everything, so it doesn't really distort relative prices. But as the revenue increases, so as you charge higher and higher specific tariffs, that's when it starts to bite. That when the cheap thing might have a specific tariff that's like 2 or 3 times its value, the expensive thing has a specific tariff that's only a fraction of its value, that's really going to tilt consumption towards the expensive thing, which consumers don't want to do. And so that's going to raise the effective price index. Not only because they have to pay for the tariff, which is fine, but because they now are tilting consumption. Okay? So that's kind of the model in a nutshell. There's going to be some kinds of goods for which you want to have a specific tariff, and there's going to be other kinds of goods for which you want to have an ad valorem tariff given the revenue goal and given the amount of evasion that there is in this economy. Okay? So let's now think about what the comparative statics are in this environment. But before doing that, I want to give you, you're all accepting that people are lying. Maybe it's just like so obvious to you. But I actually I want to show it to you directly. I want to show you that there is misvaluation in this context. And the way I'm going to do this is by looking at what happens when there's a switch from specific to ad valorem tariffs. Okay? And so what the model would predict when there's a switch to specific to ad valorem tariffs is now, obviously, importers are going to start lying about what the prices are, so that the unit values are, so they can pay a lower tariff. But it's a little bit more complicated than that. Why is it a little bit more complicated than that? Well, the whole thing about a specific tariff is that it distorts relative prices. And so when you switch from a specific to an ad valorem tariff, now the ad valorem equivalent rate, which is to say, like, if it was an ad valorem, like what percent are you paying? For the cheap goods, is falling by more than it is for the expensive goods, because that's the whole point. Specific tariffs distort relative prices, which means you would expect for a given good, when you switch from specific to ad valorem tariffs, you're going to tilt towards the cheaper varieties, just for like economics reasons that have been understood for 50 years. And so we observe that the price falls, but the price is supposed to fall. That's true in the absence of any sort of lying. But it turns out the amount that the price falls to first order, obviously, is going to be linear in the tariff rate. And so basically what the model tells us, you control for the tariff rate, and any additional fall in the price of the switch from specific to ad valorem will only show up in the presence of misvaluation. So this seems like a very natural test, but you need the model in order to isolate what the correct test is. Yeah. Yeah.
But in reality, you know, I don't actually have to buy every price. And I can choose not to end up buying that feel more expensive.
Yeah.
So, given that our income is going up,
so I can tell you for sure that I do not know how to solve the model without CES. Like that's 100%. Specific tariffs turn out to be complicated in all sorts of horrible ways that I don't have time to tell you about now, but would love to because it's so fun for me and hopefully for you. But the idea that you're distorting relative prices, that's kind of generically true. And I don't think there's any utility function in which distorting relative prices doesn't make you worse off. Like, yeah, you could choose to extensive margin not buy something, but like for like envelope theorem kinds of reasons, like that's still worse for you than the undistorted optimal. So like this feature of specific tariffs, that it distorts relative prices, that's generically true. Whether the pattern is going to look exactly like this or something else, obviously is going to depend on features of the demand system. But like yeah. So this is so far this I'm about to get to multi. This is like think of any date. Pick your favorite year. This is what it's going to look like. I'm on board with over time demand elasticities might change. There's gonna be new varieties that show up, like the economy is changing in all sorts of ways. And so this particular picture is gonna look different year to year. But in any particular year, I think under any utility function, you're still gonna get the fact that in this picture, for low revenues, specific tariffs basically don't distort prices, regardless of how you wanna buy them. And for high revenues, they do. That's kind of a generic feature of specific tariffs. And then this, like this jump, that has nothing to do with demand. That's just coming from the game. So like demand could be whatever you want, that for really small revenues, you have to charge a discretely positive tariff. And then, yeah, exactly what the slope is, like either in the undistorted or the distorted case, that is gonna be a function of the demand function. But like this jump is generic and this being at 0, that's also generic. All right. So what is this? So now let's think about the multi-category case. What is that going to look like? Well, I already showed you one. It's true in the single value case. It's true in the multivariable case too, which is if you want low revenues, as has already been discussed, specific tariffs don't distort that much. So for whatever reason on a particular kind of good, you don't want to charge a high tariff, a high ad valorem equivalent. You'd prefer a specific tariff. If you do want to charge a high ad valorem equivalent, then you do. Why? Obviously, if the revenue involved is not that high, it's not worth paying the enforcement costs because those are fixed. Like the judge's time is fixed. It's like an hour of judge's time. For a cheap good, it's not worth their time, but if you're importing an expensive thing, then it is worth their time. Okay. Second, even within ad valorem tariffs, it turns out this notion of wanting to avoid paying enforcement costs has bite. Why? Well, think about two kinds of goods, a cheap one and an expensive one, both of which, let's say, have an ad valorem tariff. Well, the difference between the net and the gross revenue is going to be cheaper, is going to be bigger for the cheap good, because like the cost of the judge's time is relatively more expensive. And so what the planner wants to do is it wants to tilt consumption away from the cheaper good and towards the more expensive good, which distorts the price index, which the planner doesn't like, but saves on enforcement costs, which the planner does like because it cares about revenue. And in equilibrium, you want to do a little bit of this. And so the second prediction is that you want to have a higher ad valorem tariff on cheaper goods, which might sound perverse to you, but we can all find out together if it's true in the data. But historically, I can tell you now, Lydia Cox and Miguel Agasta have a paper showing that it is true today. So I'll show you also true historically, but this is not just like a feature of the historic environment. Okay. So those are, and finally, even within goods where we allow them to either be specific or ad valorem, so that's just ad valorem. Now let's think about specific versus ad valorem, not just if the tariff rate is higher or lower, but if the good itself is cheaper, you want to have a specific tariff on the cheaper goods, again, because then the enforcement cost is relatively less burdensome. Okay. There's like a lot of jargon here, because as I mentioned, specific tariffs only work with CS, but the intuition I think is pretty. Okay, so the final prediction of the model actually has nothing to do with the prices. It has to do with second moments. It has to do with dispersion. Why? Well, what specific tariffs do is they distort relative prices. But if there's not a lot of dispersion in relative prices, there's not a lot of distortion that can happen. And in sort of an extreme where there's just one variety, specific tariffs don't distort at all because there's only one variety. And so you get this sort of natural prediction that if you create a spread of prices, that's going to make specific tariffs look worse, and so that's going to tend to push towards ad valorem tariffs relative to specific tariffs. Okay? So there's going to be a bunch of predictions that we can test in the model of if what planners are caring about is classification costs and verification costs. Yeah, so there's minimums in this period as well, and the model does predict that, and we'll get to that here. Yeah, it does. We'll get to that in a second. You gotta give me a little bit of grace, and then we'll get to that in a little bit. Okay. Okay. So those are static predictions. Like if we care about enforcement costs at all, like what should the structure of the tariff code look like? But as I showed you, the tariff code is changing dramatically over time, both because the country is changing and because of other things as well. And so the model also has predictions for how it should evolve. Ex ante, you may not have a stand as to whether or not the thing we get better at is classification costs or verification costs. Maybe we're getting better at verifying, the judges are getting more qualified, the appraisers are getting more qualified, whatever it is. So I don't know. But what I can tell you is it turns out that these two alternatives for how state capacity improves have opposite predictions for how the tariff code should evolve. Why? Well, suppose what gets better is we get better at classification. We get better at splitting up goods and charging different tariffs on different things. We get better at hiring particular experts with olive oil or carpet expertise. Well, that's going to give us more splits because splits are good. And then once we have more splits, we're going to have more narrow categories. Those narrow categories are going to have less dispersion. That's going to tend towards specific tariffs. Okay? So if what's happening is splitting costs, we're going to have more complexity and more splitting tariffs. If instead what happens is verification costs are falling for whatever reason, then, well, obviously that's going to tilt towards more ad valorem tariffs. Once you have more ad valorem tariffs, the benefit of having these really narrow categories shrinks because you don't have specific tariffs distorting prices, and then you want fewer categories as well. So they lead to different predictions, and so we can find out together, what the patterns look like and if they're consistent with like both of these things moving together or not. Okay, so those are going to be the tests that I take to the data in the last 10 minutes. Okay, so now I've spent some time with the setup and now some theory, which I appreciate your grace. And so now let's think about some facts about the tariff code. Okay, first, let me try to convince you that there is, in fact, misvaluation, that the customs officials aren't lying. So in 1846, I already showed you the quote from Walker that the Polk administration did not care for specific tariffs, and so they get rid of all of them. So that's why we stop in 1846. There's no more specific tariffs. Immediately, there's concern about lying in invoices. So there's hundreds of letters from customs officials and the hundreds of ports all across the country that basically say, like, these guys are lying to us, and we like literally there's tons of revenue being left on the table, and this is a huge error, and for like the cheap goods, it's not worth our time to touch, and like all of these kinds of quotes. And amazingly, so Thomas Corwin is a Treasury official at the time, like way ahead of his time. And so what he did is he basically did what we would now call an interrupted time series. So he very carefully went to the customs houses and basically for like 13 goods collected like prices of those goods over time, pre and post. Pretty good. Relative to that, we're just going to add a diff. So we're going to take some control goods, all of the goods that we found who weren't switching from specific to ad valorem, and we're going to take Corwin's numbers and just include a control group. I'm going to show you a very simple diff and diff with this extra control of the change in the tariff rate. Okay? And it looks exactly like what all the Treasury officials said it would look like, which is immediately upon impact, you see a 50% decline in reported unit values when these things switch from specific to an ad valorem tariff. So like there's lots of evasion in this context. Okay? So given there's lots of evasion in this context, now we can think about what the optimal tariff code would look like. He did not make a graph. Obviously, I would have shown you if he'd made a graph. Okay, so the second prediction of the paper is that low ad valorem equivalent, so like, take the effective tariff revenue that you get divided by the value of the good, those predict specific tariffs. So we can either do this, so I'm going to show you a bunch of tables that are basically like, for here, as I said, we have okay import data in 1842 and 1846, or I could pool the two. And so none of the goods in 1846 have specific tariffs. So I can look at of the goods that we have data on in 1846, like what was their ad valorem equivalent earlier. And you can see that the lower ad valorem equivalence is consistently predicts having a specific tariff. Medium ad valorem equivalence moderately predicts it, kind of higher, a little bit predicts it. So it's like a very sort of monotonic relationship between for whatever reason, due to lobbying or political constraints or whatever, the goods for which we want a higher tariff burden are the goods for which we have ad valorem tariffs, and the goods for which it's lower are typically specific. Within the goods that have ad valorem tariffs, for which we have unit values, the ones that are cheaper are the ones that have higher ad valorem rates. So the more expensive you are, the lower the ad valorem equivalent rate is. This might sound kind of perverse, but it's like a super clear prediction of the data. Okay, so you really, even within categories, you get the same thing. Then finally, there's the prediction that we have that like dispersion is bad. There's two ways that we have for specifics. There's kind of two ways we have of measuring how much dispersion there is. One is using the structure of the tariff code itself. So as I said, there's some labels that are very general, all other goods. There are other labels that are incredibly narrowly defined, in particular that they only cover one good. And so we can look within goods, and we can say in the years in which that good has a label that only touches it, relative to the years in which that good has a label that touches other products as well. So as it gets more narrowly defined, that substantially raises the likelihood that it gets a specific tariff. Okay. Instead of looking at the structure of the tariff code, we can also look at whether or not the good is a commodity. In principle, a good being a commodity means it has like one price. It's freely traded. Commodity markets are not that well developed at this time period, but there exists a document that has things that uses the word commodity. And so we link that document to the tariffs. And the goods which are commodities are much more likely to have specific tariffs. Now, I think this is actually a much stronger test of the model than you might initially think of. Why? Well, there's this like casual sense among people who study tariff evasion that, well, it's harder to avoid like misvalue goods when there's commodities because you can look up the price. It's like just like reported every week. And so again, as I mentioned, it's not about me knowing that you're lying. I still have to go to the judge. And so even though in principle you would think that the verification cost would be lowest for commodities, those are still the goods in which we have specific tariffs. And the reason why we think that is because, well, there's still some enforcement costs you have to pay, but the specific distortion is relatively small, and therefore that tends to want specific distortion. So that still turns out to be true. So in so much as the United States has specific tariffs, they're almost all on commodities. Okay. So finally, the thing that already got anticipated. So what about unit values? Do we see that cheaper goods are more likely to get specific tariffs? So the answer is yes, historically, with a caveat that has already been anticipated, which is starting in 1816, we have these things called minimum valuations, which are basically like, you can report any unit value you want, but if that unit value is below a threshold, we're going to charge you an ad valorem tariff, as if it was that threshold. Everyone understands that that's basically a specific tariff, right? So if you're importing a cheap cotton cloth, it's paying a price per square yard because we refuse to accept any value below that. So everyone understands that this is effectively a specific tariff. Now, this is taking the model a little bit with some kindness, and the reason why is obviously like now all of a sudden the definition of what a good is a function of the price, where the thing I told you is that the thing that is a price is a little bit hard to verify, so this isn't the world's cleanest test, but it is at least consistent with the kind of story that things that vaguely look cheaper, we're going to allow to have specific tariffs, and the things that vaguely look more expensive, we're going to force to have ad valorem tariffs, even though, of course, tons of fights and tons of concerns about like exactly on the margin how this thing is enforced. So like don't take it like we can enforce this thing literally, that obviously we cannot do, but it is at least consistent with the model. You could also look at modern data. You get in modern data we have much better records. We don't have minimum tariffs as far as I know anymore, but you see again that cheaper goods are much more likely to have specific tariffs. Yeah. So like 25 cents per square yard? Oh, what a fun question. Okay, so the way that Lowell tricks Calhoun is Lowell understands the Industrial Revolution is coming and Calhoun does not. And so when Lowell sets this price, Calhoun is like, this doesn't, no, there doesn't exist this thing on the market. And so I'm not that worried about it. And very quickly, this thing does start to exist in the market. And so eventually, like this becomes a real binding constraint. But actually, when the law was written, it was not that binding, is the answer to your question. Thank you very much. Okay, are there no questions? Okay. Great. So those are the predictions of the model that like suppose policymakers were concerned about verification cost and splitting cost. How would you write a tariff code? It turns out the tariff code is very consistent with all of those patterns, some of which we have quotes that they're doing explicitly and some of which they appear to have understood implicitly is our view. So now let's go to the evolution of the tariff code. And does the evolution of the tariff code also appear consistent with our model? The answer hopefully is yes. And so I'm going to show you that in two patterns. So the first prediction is, do we get more or fewer cuts? Do we get a more complicated classification as customs capacity improves because we're hiring more workers? It turns out the answer I already showed you was yes. I'm showing you here in a slightly different way. So the groupings are getting narrower over time. So you can see that over time we have more and more and more different kinds of goods. The labels themselves are becoming much more narrowly defined in kind of an interesting way. You might think that the way that they do it is like, if you think of any classification scheme, like first you have 1-digit tariffs, then you have 2-digit tariffs, and then you have 4-digit tariffs, then you have 6-digit tariffs. That's not the way they're doing it at all. Even in 1789, where there's very few tariffs that are defined, a lot of the tariffs are defined on really narrowly defined goods. Think like 14 different kinds of tea, a few years later, 56 different kinds of wine. Why do they do that? Well, they create very broad categories for everything that gets an ad valorem, and then very, very narrow categories that get specific tariffs. So that's like super, like that's the way that the thing gets more complex over time, is even in 1841, 1842, when the tariff code's relatively disaggregated, there's still a bunch of labels that are very broad, and then a lot that are like really, 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 really narrow. Okay, so that's consistent with splitting costs. Yeah.
Volume, and people in the customs office get familiar with these, and then there are much rarer goods that they're not like this. Wouldn't that be that would be a real access from which knowledge would matter, expertise would.
That's a great question that we've not thought of, but we can do with our import statistics if we see that specific goods are less. Okay.
So it's just a matter of if you open the package or not, but if you open the package, there's not going to be a lot of.
So again, the concern is not whether the customs official knows the price. So there's obvious lying, like things that don't make any sense. The concern is then you have to go to a judge and you have to hire an expert, and then the French expert comes and says, no, of course, what matters is the color. And so you have to have all these fights. And so it's not the customs official knowing, it's everybody else proving. But it's still, the judge still if there's no ground truth, I still need to get a judge if you choose to fight me, and the judge's time is expensive. So I really don't think the story is I really think the story is the customs officials often know that there's a lie, if they open it, but then they can't just enforce it. They got to get the judicial system involved. And this turns out to still be a problem. The trade court is a mess. Yeah. Yeah, there's one more slide, so it works out. Okay. Two more slides. Okay, and so what happens to the share of products that have specific tariffs? This is also broadly increasing over time. So as you get more complexity, you get these narrowly defined goods, as you already understood, and then you get more and more specific tariffs, except in the moment that I previewed at the beginning, which is in the 1830s when they cut the detail of the tariff code for kind of exogenous reasons. Well, now the tariff code is much more broad, and now we have fewer specific tariffs. Okay, so I think this is all kind of consistent with this model that specificity and complexity go hand in hand in the development of the tariff scheme. I'll finish with some modern data. So this is splitting the world into OECD and non-OECD countries. We have much more richness in tariff code. You can see the white bars, which are specific duties. If you're charging an ad valorem equivalent of like 0.1, 0.01%, nowhere in the world is that coming from an ad valorem tariff, but it's frequently coming from a specific tariff. The other feature, which is historical in nature, is if you look at OECD countries, we're very happy to charge 6.357% tariffs. This doesn't happen in relatively less developed countries. Hamilton understood this. Hamilton, right, for those of you who can't see, that inconvenient fractions serve to perplex the calculation of the duties. Those of us who teach undergrads are probably very familiar with this. And so this is like another potential notion of state capacity. Thank you very much for your time and for your comments.
Start filtering back in, but let's get started, try to start on time.
Thank you. Thanks for having us on the program, and thank you for reminding us of the shameful absence of Italy from the World Cup by optimally choosing as presentation overlapping with the semifinal presentation of Italians. This is joint work by two Massimos from Bocconi, both with last names ending in Elli, so very hard to distinguish. So we usually go by tall Massimo and less tall Massimo. Also Marvin is Papa Lettera from University of Zurich. He's on this paper, and we're gonna share the podium for the presentation. So populism in modern politics has its roots, or the roots of modern populism can be traced back to the end of the 19th century America, actually, when economic structural change have eroded trust in institutions among those that felt left behind with these structural changes. And more generally, technological change, we know today in more contemporary history, is a frequent trigger of structural economic transformation. It produces large aggregate productivity gains, but creates winners and losers that we know tend to feed into political polarization and backlash, political backlash. What we do with this paper, we link the GPT of the 19th century, so the general purpose technology of the 19th century, the railroads, to the rise of the first populist party, the People's Party, at the end of 19th century. What is interesting is that the populist party of the time, answered in a similar fashion to what more contemporary populist narrative does, that is by answering economic grievance of the potential voters with hard reform commitments, and by being successful in especially where trust that institutions would not be able to protect the losers would be more eroded. This particular case is also especially interesting for us as political economists, because contrary to what's happening today, in that case, the People's Party reached a peak success in 1894, but then rapidly disappeared from the political discourse, for the political competition, because the mainstream parties managed to reabsorb the populist movement through platform changes that we claim are no longer feasible today. So to do something empirical about this research question, we build on several existing literature. And the first one is gives us the empirical framework, and it's the literature by Donaldson and Rick and Martin. Of course, we also build on contemporary literature on the impact that technological and trade shocks have on economic structure, and in turn how this impact on economic structure affects political backlash. Massimo in particular has worked a lot on how populist parties respond to the economic grievances generated by these technology or trade shocks. And so we are going to borrow from conceptual framework from this literature. What we are going to document empirically has a direct parallel a bit to the European grain invasion, and in general to the first globalization wave of that period. So we look also at that literature to which many in this room have contributed. And finally, there is a literature both in economic history and political science about the People's Party in that period, and the roots of its success in the 1890s. Let me tell you a little bit about the People's Party if you're not familiar with it. It's not something that appears all of a sudden in 1890s. It builds on several movements that come after the Civil War. So right after the Civil War, farmers in particular started showing distress and discontent about their falling economic status. In particular, they formed the grunge movement, a grunge movement that was focused on fighting against monopolistic railroads and grain elevators prices, and in general about monopolies of railroads and grain elevators. Then this movement added as a stance a fight against the tight monetary policy of the time and for the expansion of the monetary base as the falling prices, farming prices, were making it harder for them to repay the high debt that they already had. This turned into the Farmers Alliance, which have incorporated also the new African-American farmers into the movement, and also added silver coinage as an extra proposal. And finally, these movements formalize into an actual party that challenge the existing political equilibrium that took the name of the People's Party in 1891 and became an actual third-party challenge, one of the most successful in American modern history. And so in 1892, the populist candidate Weaver won 8.5% and 22 electoral votes. And the People's Party reached its peak in the House elections of in the midterm election in 1894, where federally at the national level they reached 10%, but at local level they reached much higher, especially in the South and in the Midwest, much higher vote shares. And so we're going to focus on this peak election, this peak moment for the People's Party as our outcome later on. So what's interesting about the parallel between then and now is that the grievance, the economic grievance of the farmers of the time was, in a sense, very similar to what we observe in more contemporary times. So this idea that the economic structure changing, creating a heightened sense of insecurity by exposing farmers to market forces that felt beyond their control. So this idea of losing control of the market and losing control of their production is what destabilized the farmers and felt like they were at risk more in the long term and not just by a temporary shock. And so other historians talk about this sense of losing control over the market forces as a commercialization. So with this idea that railroads force farmers to depend all of a sudden on distant markets, like distant and not very identified markets. They made them dependent on railroad and grain elevator prices, more on creditors and merchants. And so there is a quote still from the book by Eichengreen in 2018 from a country gentleman in 1892. There is no shortcut by which farmers can escape from present conditions. They are the results of the rapid settling up and improving of unlimited fertile acres. Valuable as the improvements in farm implements and machinery have been, they have contributed to the ruinous competition made possible through cheap lands and an unhelpful credit system. So there is this idea, this grievance against these, the loss of control, these forces that are not well identified. And what is interesting is that the People's Party of the time respond to this grievance with a clear platform that has, if you go and look at the narrative and the mission of this platform is very similar to what modern populism would do. So the idea of proposing hard reform, hard commitment, so hard specific reforms aimed at taking back control of the lives of the plain people. So these party manifesto that launches the challenge of the People's Party has as an introductory claim that the People's Party will aim to restore the government of the Republic to the hands of the plain people and away from the established politicians in Washington. Railroads were seen as a sovereign fight. So in the manifesto, the manifesto says the railroad corporations will either own the people or the people must own the railroads. They also call for national currency issued by the general government only, so they are against the mediation of banking corporations. They want free unlimited coinage of silver and more direct democracy against elite capture. And on top of that, the People's Party also introduced more general themes, so a graduated income tax, and also what we call exclusionary populist reforms, such as restrictions on undesirable immigration and unfair labor competition from migrants. Yes. Yes, they are not anti-globalization, mostly because in that period, the US was a net exporter of agricultural product. And so these farmers didn't want trades and for fear of retaliation against their own export. Yes. So this narrative was not just very strong in the political competition, also made it to one of the most popular novels of the time, The Wizard of Oz. And so other economists have already drawn a parallel between the narrative of the People's Party, or the populist movement of the time, and The Wizard of Oz. And with the idea that Dorothy represents the plain people, and joined by the scarecrow, the farmer, and the tin woodman, the dehumanized industrial workers, they walk on the yellow brick road, representing the gold standard, towards and march towards Emerald City, with the wizard representing the establishment politicians that look like they are good-hearted and try to help them reach the goal, but at the end they reveal themselves as an illusion that doesn't really help them reach the goal. And finally, as many of you will have in mind Dorothy as having red shoes, but the original novel had silver shoes, and exactly because they were it was referring to the free silver coinage that would be the populist cure against the grievances and the distress of the farmers of the time, or the plain people of the time. So now I want to move towards what we're doing empirically. And so we look at a period that is in between the Civil War and the success of this People's Party. So in particular, we focus on the structural economic changes triggered by US railroads, triggered by the expansion of US railroads between 1870 and 1890, a period in which railroads have tripled, more than tripled, and so and made both interregional trade and intra-regional trade much cheaper than before. And as we know by the literature of Martin and Rick, railroads increase land value for an average county by 60%. What we focus on, what we contribute with this work, is to construct a new measure of how much farmers might have lost, or we contribute by constructing a measure that try to capture the counties that have lost by the increased competition brought by the railroad. So with the idea that while technological change, in this case, the market integration that came with it, raised dramatically the aggregate productivity, but then created winners and losers, we try to measure the loser empirically. And so I'm going to walk you through our measure of what we call technological disruption exposure, which builds upon the empirical framework already laid out in this literature on market access. And so we have in mind a complete network of all US counties. So we focus on one destination county, which is linked to all other counties in the US. And so we start by measuring potential, what we call potential vulnerability, which is the ratio, the relative yield, or the relative potential yield in a given crop, J, of the origin county relative to the yield, the potential yield of the destination country, with potential yield being how much a county can produce just based on exogenous agroclimatic measures, so soil and climate. That thing doesn't have soil? Like, they don't predict. Okay. I see. Okay. We'll try to think of then also of alternative measures to test the robustness of this. Yes, Sarah?
Seems like it might be valuable in this report for exposed, but I think a lot of what you're discussing is cited their incumbents for being effective. So should we think about this, the measure you're constructing here is turning off this possibility of like moving people from being laborers to farmers, for example, and to just be
I think, I mean, this measure is trying to capture incumbent farmers and how the integration will make some of them take advantage of the integration if they are more productive in a specific crop than others, and will generate losers of the market integration in the case of farmers that had a comparative advantage or were the most productive in an isolated market, but now lose this competitive advantage once integrated with the other farmers. So this is the goal of what the aim of this measure in terms of capturing those who are the losers of the market integration. So this is this first measure captures this what we call this potential vulnerability. So the potential productiveness of each origin county relative to the destination country we are focusing on. Then we interact this with the shipping potential, so the production before the railroad expansion, production of the origin country or county in that crop J relative to the population. And then we interacted with 1 over the iceberg trade cost at the time which captures transport cost. And so how much this potential vulnerability turns into an actual threat, with the idea that the more productive the origin county, the higher the shipping capacity, so the excess production that they have in the crop, that the origin county has in the crop, and the lower the transportation cost becomes from that origin county to destination country, the higher the potential competitive threat comes to the destination county O. Finally, we average over all origin counties and all crops. We focus on 14 crops. And then we weight by the share of the destination county's output that is in that one crop. And so we sum over these 2 dimensions, and we come up with this competitive pressure measure we call T of county destination D in ERT. And finally, we define the technological disruption exposure measure as the change between 1870 and 1890 in this competitive pressure. So the flavor of this is the flavor of, if you want, a Bartik shock, in which you have initial weights that are fixed, that are all fixed, the potential vulnerability and shipping potential, and are interacting with the railroad shock that brings down the trade costs. Yes, Eric.
In some cases, the railroads were enjoying monopoly power over transportation. You know,
Yes.
There's a segment of the country where only one railroad goes, or a spur off a railroad that only, and so they can charge very, very high transportation costs, even if the distance is short. And so they're sort of lobbying for uniformity in rates based on distance. So you can't, you know, if you have monopoly over a short distance, you can't actually charge a high rate on. Like I thought that was part of the platform. And this doesn't seem to have that much to do with like monopoly in transportation.
Yeah, I think like this type of grievance or upsetness is going to be stronger and more important where that the cost that comes from when the monopolistic cost is really like driving you out of business. And so when you start from losing already competitiveness and then the same, but yeah, I see your. I see.
But the other way, like if it's super high to transport some product from your county, it's also probably expensive to transport it to your county, and so it's insulating you from these competitive pressures, right?
Yes, but if the gain in productivity, gain in yield of the destination country is so much higher than yours to more than compensate this cost, you're still going to be flooded by, and you're going to be outcompeted by the origin county. This is what we have in mind, but it's fair point, and we're going to think about it more. We haven't. Leah?
About potential crop yield. Couldn't you just use the actual production from the pre-railroad period to say that some places were producing a lot of a certain crop and some places were producing something else, and then the people in that county who were doing the thing that was not a very abundant crop in that area, then when there's imports from elsewhere of that crop, they're the ones who
are.
Or do you,
Yeah, I mean, it's a bit captured by this green. So one robustness check we could do to respond, I was thinking now that you are mentioning this, is to just like exclude the red component that might be problematic and only use this, if you want, export capacity.
not necessarily.
Yeah, yeah.
The share of a country's export basket that comes from a particular product.
Yes, we could. Yeah. Yeah. Yeah, we could. So I guess we went for the road of having something that is as exogenous as possible to where the railroad is going to be built. So maybe what you have in mind might be a little bit more endogenous to then where they build. So I would have to think about it. But yeah, it's a good. Yeah, very great suggestion. Thank you, Martin.
I don't see comparator advantage here. I don't see third market effects here. I thought there's all sorts of forces going on, directions that aren't.
Okay, so you would like to see the structure behind or the assumption? Yeah. Yeah. Well, I mean, we started having in mind like basic assumption of the model by Donaldson and Rick, if you want, and building on those assumptions. We don't have a structural model at the moment, but we could, yeah, do much more in this sense if you think it's okay.
It's okay if I start trading with someone better me at one good, I'm better with them in another good, then we get to trade. The whole reason why we like trading. So like, this doesn't show up.
Okay. Okay, we'll have to think much more structurally than of if to this measure. So overall, idea the final intuition of what this measure is trying to capture is the rise in agricultural competitive pressure as lower transportation costs let higher yield counties reach its market and potentially undercut its farmers. If we plot our measure on the US map of the time together with the railroad's expansion, the gray lines are the initial railroad network and the black one is the expansion. And you can see the densifying of the railroad network. And also you can see that where the railroad arrives, you have both areas that are very light and areas that are very red in this map. That's the type of variation that we are exploiting. Yes. With high. Yes, correct.
Question, I mean, when I think of what the populous strengths were, they're in your white.
Yeah, we're going to use only within state variation. So we're going to compare counties within state. So you shouldn't really think of north and south in terms of where the People's Party was strong. So in this sense, there are missing data at county level, both on the voting side and on the measures that we're using to build. So some of these areas are missing, but we still cover a lot, at least 120 counties just in the Midwest and in the South, which were the areas where the People's Party. Okay. Okay. Yeah, so we are facing some limitations, but that are purely data driven. We might be able to do much more. So we are gonna, if you think that, this is going to be crucial to expand the sample, especially in those areas, we are definitely going to work in that direction. So just a sanity check. Here in this slide, we look at the change in the share of production value of a given crop J in the period. And we regress it against the state fixed effect and our measure of technological disruption exposure that is calculated only for for the same crop J. And so what we see is that counties that have a higher exposure, that are most negatively affected, reduce the production in that one crop for which they suffer the increased competitive pressure. And this is true for these seven crops. It's true also for all other 7 crops that we focus on. Sarah? Yes, we do robustness check also on our results by excluding wheat, for instance, which is much more tradable also abroad. We do, and it's all robust to excluding some. Okay. Yeah, we could exploit this to validate even more that, yes, that's a great idea. Thanks. Yes.
Like on the west, the US is trying to extend, like these railways are getting people out there to farm land and also make their interactions.
Yeah.
This period heavily dependent water. So I think that I don't think it's as simple as like now you can bring in options.
Okay. Okay. Yeah. Okay. So, I mean, again, our identification is going to come only within state. So, but these contextually are going to are things that we need to think more about for sure. But yeah, so I mean, this more is going to matter for like where the effects that we find shows up, or try to explain, you know, the external validity of our results. And yeah, we can. Okay. Yeah. Okay. Yeah, we should think more. I didn't know about these. We didn't know about this type of dynamics going on. Yes. Thank you. Yes. So okay. Yeah, we need to speed up a little bit. So in the next table, what we want to show is the crucial structural economic change that happens at these cleavage, or at these particular shock that we are estimating. And so for this specification, we are looking at changing of several outcomes on our measure of technological disruption exposure, and the change in market access, the way it is measured by Martin and Rick, and state fixed effect. And so what we find is that in areas that are more negatively affected by our technological disruption exposure are areas that have a lower number of farms, a negative change in number of farms, a reduction in the share of farms that are small, a reduction in the value of farming equipment, reduction in farming output, reduction in farming output by square mile. And especially this is important because it really maps into the narrative of Eichengreen empirically of what's happening, and generates the grievance of the farmers. We see that counties that are more negatively affected have a decrease in the share of farming, of agricultural workers that are farm owners, and an increase of agricultural workers that are working for a larger farm. So it's a type of structural change that is also qualitatively described as the one generating grievance. So the idea is that we, and then of course, very importantly, all of these outcomes go in the opposite direction for the coefficient of the change in market access. So we think that we are really identifying this economic structural change that then we can map into the political cleavage that forms. So these are the data that we could manage with a lot of extra work. Martin, yes?
No, you should think of the TDE as identifying, in a sense, the directed network, right? Whereas the market access is giving you the total access, right, with the exports and imports. So you cannot really sum them.
With the railroad, you're both, but I mean, market access just, you know, it's like bidirectional. And so our measure is one direction, in the sense it determines where the direction of the trade goes, and so who loses and who wins along the same trajectory. So by yeah.
What you expect the total effect in
Okay.
be positive or negative seems like some linear combination of those coefficients.
Yeah. Okay. We can think of that. I mean, yeah. Yeah. Yeah, I mean, from a political economy point of view, I think like it doesn't have. I mean, we don't even a necessary condition to create a political cleavage that these areas like are losing in an absolute sense. It could be just, you know, that they are losing relative to the average gain in the economy. I mean, we know even in more modern episodes of populism that is the case. And yes, Daniel. Yeah. Absolutely. Yeah. Yes. So we are not going to have time to go through the billion robustness and effects. It's all what we find is fully orthogonal to the overall change in migrants, and even by just looking at Chinese migration or migration of from other ethnic groups, it's completely orthogonal to this. I mean, to our surprise. Yeah, yeah, okay. Yeah, we can do more in terms of looking at population side. It could well be that the share is decreasing because people are leaving and those who remain are politically selected. We can definitely do more. Sarah? Yeah. Okay. Yeah, we definitely have planning to do more. So this is the map of the vote share for the Populist Party. So we have done a lot of work to expand the data at county level, and they were missing or lost and are not in the ICPSR dataset. And so this is the main results, looking at the same cleavage that we have looked at in terms of the economic structural change before. So we have, focusing already on column 2, our measure of technological disruptive exposure, and at the same time, the change in market access over the same period. And so we see that areas with higher with one standard deviation higher measure of technological disruption exposure, TDE, are 3.3% more likely to vote, to have 3.3 percentage points higher vote share for the populist party, and the market access goes in the other direction. Is not statistically significant, but it goes in the direction that you're expecting. We have a lot of robust checks. We can talk a lot about that, a lot about them. Mostly we control for the initial pre-expansion, railroad expansion level of vote share for Democrats, for potential minor populist movements, and the effect remains there. Here is where we also control for the change in foreign born, and the effect is still there. And we do a lot more in terms of the exogeneity of the railroad, or where the railroad is built, and everything is very much robust. But at this point, we have only 12 minutes, and Massimo is gonna kill me because we wanted to, I'll
kill you later.
Yes, it's gonna kill me later. So I leave you with a concept.
Yes. So my role here is to give you a conceptual framework with which you understand why this TDE measure is really connected with populist voting. So the political economist in the duo here, or the one who has worked on populism the most. So think about this simple idea that from the point of view of a voter, normalize to 1 for simplicity the value of whatever you care about, the wage, or keeping the job, or keeping your farm on. And so your expected utility of the status quo, you can view it as something as simple as P plus 1 minus P times Q, where P is the probability that you can actually keep the farm. So ex ante, you think, yeah, I'm good enough, my soil is good enough, my farm is productive enough, etc. So P is the probability that I'll stay on. But in case I'm losing, that is the other parameter. Q is how much I trust that institutions or banks, that some outsider will help me to bail me out, right? So in a sense, P is more or less like trust in my ability in the market, or my productivity in the market, and Q is the trust in the institutions to help in case I'm the loser. Okay, and so obviously the TDE affects P the most, right? Because having an increase in this TDE, having this change in exposure makes me feel less likely to survive in the market. Okay, and now the Q part. Now I think I moved to the slide on. Yes. So the Q part, you can think of it as coming from mostly 2 conceptual directions. One is alignment and one is capacity, right? Because even today's distrust in institutions for today's populists is based on, first of all, voters thinking that the politicians are more aligned with money, power, with elites, etc., than with their own interests. That's the alignment component. But there is also the other thing that, even if the institutions or the state, etc., were aligned with the interests of the voters, there is the issue of whether they are capable of helping, because, depending on depth and budgets and size and so on, there could be more or less money to intervene, redistribute, and so on and so forth. Okay, so those are the two parameters that are enough for this conceptual framework, from which we can generate also the predictions for heterogeneity, and you can think of the mechanism through them. Okay, so you can think of the most exposed counties as those where TDE is large, such that P is low, but where on top of that, maybe credit access is low. Okay, and that gives you a low Q. So if you have both a low P and a low Q, you are now more willing to listen to proposals of reform that may be quite drastic. And so the proposals of reforms could involve things that are related to P or related to Q. And if you want a textbook case of commitment to reform, is actually the Omaha platform, where we are saying, okay, we hear you. And so if we go with the silver coinage 16:1, this basically will compensate the deflation that is coming from the gold standard. So the reduction in prices, that is one of the reasons why you are thinking that you are going out of the market, will be compensated. On top of that, we would like to argue in favor of regulation of the monopolies and reduce the excessive pricing of the railroads and the grain elevators and all that. And then they were putting into the long run part of the reform, the graduated income tax that wasn't existing. So again, kind of protecting the losers, so to speak. Okay, and then also things that related to alignment, like commitment to eventually have direct election of senators, direct democracy, initiative, referendum. So all these things are related. You can think of them as being related to the P and Q part. Okay. So that is for the Omaha platform. Now for the heterogeneity predictions that are related to the PQ framework, you can think of at least two things that empirically you can check that could amplify the effect of TDE. One is the crop specialization, because if you happen to be a county that where farmers are doing only one thing, and if it so happens that that one thing is produced more productively somewhere else that is now reached by the railroad, and now you are reached by the railroad, then, oh my God, the whole production that we have is now gone. So cross specialization, which is going to be captured by the Alfindal-H index, is going to be something that interacting with TDE should give us a bigger effect. The other thing is, of course, in other measure of how much the county is dependent on agriculture. Because again, if there is a high TDE and the county is very dependent on agriculture, you should expect a bigger sign. And similarly, on the Q side, we could check whether indeed, if this framework helps with the TDE measure, we should expect that, for example, when there is less credit access, that should be like a lower Q. So again, in that case, even there is an amplification. And for example, low human capital, low ability to read and write could be something that makes it difficult for the farmer who is losing the job to figure out what to do, figure out how to apply for a loan, and so on and so forth. So let's see whether these things pan out to give us hopefully more credibility on the whole structural framework. So as you can see from this slide with the 6 columns, the first 3 are about P, the second 3 are about Q, the Q part, right? So interaction with HHI indeed pushes up the effect. Interaction with the log of farm value over per square meter, or log of farm output per square meter, is the agricultural dependence measures. Again, interacted with TDE, they push up the effect. And in fact, instead, if you have greater access to banks, in particular the columns 5 and 6 with deposit and loans show it well, they have it's kind of a tampering effect. So it seems that all the data are giving us some support for the thing that the whole mechanism that we have in mind. And on the human capital one, and this is things that we are seeing also in other papers, you see not on the TDE part, but in terms of the intuition, it's quite common that indeed, having lower education or in the county, less ability to read and write, etc., makes you less able to cope with change. And this, again, is completely consistent with the lower Q, in this case, in terms of human capacity to react. Now, the Democratic Party realized, I guess, some of this, and in 1894, there was the maximum success of the People's Party. So 1896, the Democratic Party adopts, basically, this is the interesting thing, adopts almost verbatim some of the commitments of the Omaha Platform. Think of it, for example, of the silver coinage 16:1 respect to gold, exactly the same numbers. You know, of course, they tempered some things like the property rights stuff and so on, but pretty much 1896, you can think of this as almost copying this part by the People's Party. So they clearly wanted to absorb the People's Party, and why did they succeed, at least in the reabsorption component? The thing is that you can think of those proposals as quote unquote credible, especially when proposed by a party like the Democratic Party that in principle could win because it was a large party, not a third party. And you know, proposing a graduate income tax in the future was definitely feasible. We are not talking about a period of time in which taxes even existed. So the feasibility was not an issue, whereas today it is. And the gold standard, you know, the criticism was there, had been there before, and now it kind of felt perhaps easier to propose this reform at the time where maybe they even thought that they didn't even need to implement it, because at the same time other gold was being discovered, and so the supply of gold was not as limited as before, and so this promise was like a promise where they didn't even have to necessarily deliver. So they did absorb the party, but as we say here, this successful reabsorption is without victory. Why? Because in contrast with the fable, you know, of the Wizard of Oz, where in a sense there is this coalition that the People's Party wanted to form of the fellow victims, right? The Scarecrow, the Tin Man, and the plain people. They all go to the Wizard of Oz, solve our problems, etc. But when it comes to actually doing this, proposing the silver coinage and to stop deflation and go up, and the fear of inflation actually divides the interest of the Tin Man and the Scarecrow. And in a sense, that's why industrial labor didn't follow the strategy of the Democrats, and the Democrats actually lost in 1896. Okay, so that's kind of tells you the more or less the whole story, although very quickly on my side. Why not today? Well, today is very difficult to imagine how to do the reabsorption, because the credibility of some of the inclusive welfare redistribution policies, etc., that can increase the queue is very limited. There are many countries have a debt over GDP or debt service costs that are very high. The taxes are already very high. The space of maneuver for governments is like a straitjacket, and so thinking about inclusive redistribution within the current institution is not believed, and that's why, you know, in current populism, the predominant commitments are exclusionary commitments, like closed borders, closed markets, kicking people out, making people think that the game is a zero-sum game. Okay, and that's why it's very difficult to get out of this thing. Much more difficult than before. So to conclude, since not enough time, we think that the three main contributions are, first, to have given you some causal identification for the first time of how technological and structural change affect directly from beginning to end the traction of populist parties. And then, we have some heterogeneity results that confirm at least the plausibility of this simple PQ framework that is very rational, doesn't involve any identity politics or whatnot. And then, of course, the issue is that we identified that this case of populism gives us a sense of the full cycle, rise and fall, and we identify that we can use it to think about what what patterns could apply to today and what patterns could not. And then one final note to Martin's point before about the structural model that we could add. You know, the assumptions would be very similar because we can continue to assume perfect mobility of labor, perfect mobility of capital, CES utility functions, and that would give the sort of similar derivation. But here we are focusing on a measure that captures how big the arrow towards me, destination county, is from the other origin county. So because it's a focus on, because TDE is how big the arrow towards me of the pressure, I don't think we can reach, we can try, but I don't think we can reach a model where the MA and the TDE will be sum of the other. So that question, it's in my mind, I'll work on it. Thanks.